Interpreted. And let's go to UK retail as well. Citi saying that Currys shares look as if they could rise this morning after the electrical retailer revealed sales returned to growth and delivered an earnings beat for the first half. So we'll look to see if we get any upside from Currys at the start of trade then, Guy.
Trading into Christmas looking all right as well, certainly in line with expectations for Currys. Let's talk about what is happening in these markets as we anticipate this Thursday open. Not a great deal anticipated in terms of movement. Single stocks, there could be some interest here. So we're expecting a little bit of negativity, but I would say actually probably a fairly flat market. FTSE 100 is absolutely flat as a pancake right now. We're up by 0.1%, struggling to hold that a little bit. Maybe we'll continue to remain in positive territory, but I wouldn't hold your breath. Stock 600 out of the gate with a very exciting 0.04%. I still think my nothing is stirring story probably fits the bill. The IBEX is down a little bit. The CAC is expected to be reasonably flat. We await political news there as well, but actually maybe a little firmer than actually most of the other markets, up by 0.4%. We await the DAX. While we await the DAX, I would urge you to read Michael Masika's fantastic piece this morning talking about why this market has had such a strong rally thus far this year. Kriti, what else are we watching?
Well, we're certainly seeing some outperformance when it comes to some of the bigger kind of players here, your sensational six, your core six. That's what's moving the market this morning. LVMH is your biggest index contributor to the upside. But then, Anna, we have a little bit of a sprinkling, if we will. That's a broader conversation of some of the commodity names. Shell is kind of your number 2 biggest index contributor, but I'm not seeing a consistent commodity trade this morning.
No, and things look a little divided, don't they? Roughly half the sector's going higher, or just more than half the sector's going higher. Just a little less than half of the sector's retreating, and consumer products seem to be at both ends of the spectrum. So we've got the consumer products and services sector as the best performing, and you were talking about some of the luxury names in there. So Bruno Cucinelli is higher, Christian Dior higher, Burberry higher. Is this all to do with the Chinese consumers going out with vouchers and spending them? That could be what is driving that. We don't know if they're going to get vouchers, but that seems to be one of the news lines being pursued through the Asia session as we wait for the conclusions from the Works Council. To the downside, the more regular stuff of life, we have Unilever and Carrefour, Reckitt Benckiser, those kind of names trading a little bit weaker this morning, but there's not much in it. We're waiting for further details on the US inflation picture and the ECB, of course.
Vouchers. Is this the equivalent to sort of checks that were handed out during the pandemic to US consumers?
Yes, maybe. It's like getting in a helicopter and throwing money out of it. Isn't that the old metaphor people used to,
or vouchers.
Used to talk about?
Is that what you do on the weekends? You get on a helicopter and you just throw money?
You've got his weekend.
You have a very different perception of my weekend than I do. Yeah, Unilever's down quite sharply, down by 0.9% this morning. Nestle yesterday. Nestle was at a 52-week low yesterday. So some of those consumer names, those staple names out of Europe have been under real pressure recently, and that continues today with Unilever soft. Reckitt Benckiser down by 0.6% as well.
We should very quickly mention that Italian bonds have also seen a pretty decent drop this morning. The 10-year yield higher by about 5 basis points. We're looking at 3.24 on that 10-year yield. It's still unclear what's driving that move, but something that we're going to be monitoring throughout the rest of the show. Let's get a little bit more analysis this morning. Sonia Loud, CIO of Legal and General Investment Management, joins us around the table. Sonia, pleasure to have you on the program. I feel like we're talking about so many different topics this morning, so I'm gonna start off very generically. What do you think is driving markets into year-end and into 2025?
So into year-end and into early next year, it will clearly be fundamentals. You know, you will see the same obsession around central banks. The ECB will be in focus today. We've at length talked about the Fed and the potential rate cut cycle there. So it is really focusing on the data points that the market can take for granted, so to speak, and that are real and hence can drive a little bit of the narrative. The reason why I've been focusing so much on early next year is because then, of course, we will see political events taking over. And I think that is what makes a 12-month forecast so incredibly difficult, because we're talking about binary decision-making. And let's face it, developed markets are not particularly good in pricing political risk. I think we all have to ask our emerging market colleagues on how you do this properly, because they will, of course, have this as part and parcel of their overall analysis, whereas we have taken political risk normally as a side event to fundamentals. But given that we're looking at policy decisions from governments driving fundamentals, that turns everything upside down.
So what's the roadmap there? What's the gut instinct? Do you trade the volatility? Does that mean shorter bets that you kind of get in and out of? You pursue liquidity, or does that mean staying on the sidelines until you get clarity? Which one is it?
So we're relatively neutral risk, but you're absolutely right. If you look at duration and the positioning within government bonds in particular, you've had quite a few trading opportunities this year. It wasn't a smooth journey. You know, there was quite a lot of volatility. If you just consider how the market pricing for the Fed curve and for the dot plot has been changing, it's you know, phenomenal. And of course, we are now still expecting a number of rate cuts, although it's far more subdued than what it was back in September. But of course, even that can change dramatically depending on decision on tariffs, decision on immigration. Of course, fiscal and tax cuts will probably only appear at the end of 25. So the market will have to wait how this is all coming along.
Why do we think the developed markets are bad at pricing political risk? I look at what's happened since Donald Trump has been elected. It's been fantastic. Everything's fantastic. It's amazing.
I know.
Is that not real?
It seems the market, for the time being, is very much buying into the good pieces, right? So because he has promised to extend the tax cuts, there's potentially even more. The fiscal support is there. So there's a lot of positives in there that the market currently is hanging their hat on and say, we're going with
political risk. This is just political
support.
Yes.
Until we come to tariffs and, of course, immigration, because we should not forget that immigration in particular was growth supportive last year. If he wants to reverse it, and, you know, I know there's a lot of logistical questions, how quickly, what you can do, he can definitely address the borders and shut the borders, as he called it, straight away, which means, you know, the supporting element we've had last year, and we've talked about the 3 million people, will immediately be removed. And likewise, tariffs, you know, we've heard Janet Yellen earlier, it pushes inflation upwards.
But there seems to be this view amongst so many people I'm talking to at the moment that Trump is transactional. That if something bad happens, he'll just change course. That if it doesn't work and the markets go down, he'll deliver a different outcome. That seems to be everybody's narrative at the moment. Is that incorrect?
It is very much looking at the playbook from 2016. The fundamentals were very different in 2016. Valuations were very different in 2016. And I think that the world didn't quite know what to expect from a President Trump. And it seems that right now we're literally going into the same playbook. But to our mind, he has received a very different mandate. Whereas in 2016, I think he's tried to find his way through the establishment in Washington. I think you see from his selection of his running mates quite clearly that he's aiming for a different proposition this time round. And I think the market is honestly in that context waiting, but is definitely taking the positive playbook from 2016 and potentially ignoring that, where we are in interest rates, inflation, corporate tax rates, frankly, and all the other areas. We're at a very, very different part of the cycle. And hence the additional stimulus might be far more difficult to come by than what it was back in 2016. And if you then look at valuations, you have to wonder how much more you can get out of it without running out of road.
Okay, and so in that context, Sonia, you might start looking at private markets and thinking, what will we find there? Talk us through your expectations for private markets in 2025 and what kind of allocation people should have, you've got, to private markets, because this seems to be increasingly a conversation that we can't avoid around this desk.
Yeah. No, absolutely, because you will not have any client meeting anymore where the context of alternatives and privates will come up for very good reasons. They are providing a level of diversification that, I mean, we have always talked at length in public markets where you find those uncorrelated asset classes that will help you to balance potential volatility. And here, private markets will help a lot in offering exactly this. Now, the questions, of course, that we are having is if you look at the amazing growth that we have seen across the alternative spectrum, you know, if you look at the price discovery mechanism where there were quite a few questions, why have public markets corrected so dramatically compared to some of the private counterparts? But at the end of the day, we are expecting this growth to continue. There is, of course, always the risk. We talk about alternatives. These are very distinct asset classes.
Yes, very different
and we
to each
have
other.
to be very careful not to summarize all our assumptions in one go. But if you look at what clients are looking for, then areas of infrastructure and private credit are probably the ones where we see most interest and logically aligned to structural long-term themes, which could drive this.
So it was really interesting we had a conference on Monday that we attended, and Jenny Johnson was there, and she was talking about how some businesses, because of these long-term themes around investment, some businesses were actually forced or advised or decided to go private and to make investments in the sort of private space and then, you know, maybe consider relisting again, as if public markets are not very good at allowing the time horizon that these businesses need to make investments right now. And that's what we hear from a lot of people who are pushing private assets, of course. But that, you know, you'd expect that. Is that really the case, Sonia, that the public markets are being found wanting in terms of the time horizon that they allow senior executives?
Yeah, you're definitely seeing that, in particular, given that we're talking a lot about the energy transition, and this is an area where you increasingly see that, of course, private markets are probably providing a better framework. Why am I saying this? Because public markets do struggle in pricing or forecasting 10, 20 years in a way that would then allow individual investors right now to see the benefit. So there's a real disconnect, and there would be quite a few companies that have said, we believe we have been doing the right thing and our long-term strategy is properly aligned with, let's say, a net zero pathway, yet the stock market or the bond market doesn't give us any credit for it. So there is something in there that probably is better reflected in private markets, coming back to the price discovery mechanism. So you might find a more beneficial setup there.
The era of buybacks, dividends, driving so much of corporate Europe, is that era over?
I think corporate Europe will look increasingly what level of growth they can deliver. And if you are in the exec or on the board, you really have to challenge yourself whether the way you allocate capital is in the best interest of all stakeholders. And as such, you know, you will clearly find with the European growth profile being as subdued as it is. I know you mentioned earlier that, of course, in Germany, for example, the vast majority of revenues are actually generated outside of Germany. But still, you have to make sure that the growth trajectory in your journey is commensurate with your ambition. And then, you know, there will be always a balancing act, how much share buyback and dividends, which will probably drive share prices more in the short term, will really allow you to deliver the long-term growth profile that attracts global investors.
I hear you, but does it matter? If you have outperformance out of China driven by these stimulus talks, if it indeed does yield results, and economic kind of outperformance out of the United States, and that's what's driving your bottom line, does it matter if Europe as a region is underperforming, if your exposure is outside of Europe?
No, it doesn't. But of course, if you're a French luxury goods manufacturer, it did matter that China didn't do quite that well, right? So you have to make sure that your diversification will allow you to have a less volatile growth opportunity than what we have seen in some of these companies being reflected. So hence, coming back to the capital allocation and your overall global strategy, you want to make sure that you are well diversified in order to avoid any of those shocks.
Comes back to that golden rule of investing. Sonia Loud, CIO of Legal and General Investment Management, we thank you so much. As we were speaking to Sonia, we did get some headlines coming out of Italy. The Italian consolidation story continues. Getting the official nod, Banco BPM is, from the Italian competition body authorizing their Anima bid. We should put that into context. And I have a map pulled up on my Bloomberg terminal, because there's no way to really do this without one. They already have a 22% stake in Anima. They also are trying to bid for Monte Paschi. On top of that, UniCredit's trying to bid for Banco BPM and get all that exposure
And
to the small
Agricole
banks.
potentially as well.
Potentially, and that French consolidation story. Looks like this morning, though, Banco BPM higher by about 0.4%. It was higher earlier, so it paired those gains, but that's something to watch.
Is this a kind of poison pill? If they get this acquisition, does it get harder to take it over? Does it make it harder for UniCredit to step in and deliver on this? Because the indication was that maybe UniCredit didn't want that business.
Yeah.
So if it acquires that business, just complicates and muddies the story, doesn't it?
I think what I'm so confused about for Banco BPM, and this is a longer conversation, but is they have so many, and even Anima has so many different bids for so many different companies. They're in the middle of like 4 different deal transactions that may or may not come to fruition at the moment.
May or may not. Seems to be the story there. Let's talk about the core 6. What is happening right now? Let's take a look at what is happening with luxury. I think a very good today. Named a good day today. LVMH is up quite strongly, as you can see, up around 1%. Names like Cucinelli are doing even better this morning. So we're watching some very strong numbers coming through there. Cucinelli raising its guidance, so that's also helping out the luxury sector. You're seeing a strong performance, potentially also being driven by some news out of China. Ferrari's up quite nicely as well. ASML, the chip story seems to be back a little bit. Nestle down another 0.2%. Hit a 52-week low yesterday. That continues today. Nestle now trading at 74.62. A real spread there in terms of the performance we're seeing. Novo also at the other end of the story, down, other end of the board, down as well by 0.7%.
Let's talk about the defense story as well. We are seeing green on the screen when it comes to those defense stocks. I should warn that the entire market seems to be higher, so I'm not sure if this is necessarily driven by the news we got out of, say, NATO, for example, talking about increasing their defense spending as a function of their GDP. Remember, they had that 2% rule. They've had some political pressure, specifically out of Poland, to push that up to 3%, maybe even higher, and now that's being taken very, very seriously. Perhaps a tailwind to that defense story.
Can I just point out that Juventus' stock is up by 8.4% today? They beat City 2-0 last night, I think.
Is that a defense story?
It's nice to see. Well, the defense was quite good.
Yes.
The attack was even better. So yeah, a little sports to financial markets story going through there. In terms of other news, I hadn't actually spotted this one, so let's talk a little bit about what's happening with Hays this morning. Its stock is down by 5.25% at the moment, 5.3%. This coming after an update that we have seen coming through this morning. Material positive impact though on free cash flow from 2026. The outlook may be actually a little bit interesting this morning. I need to get some more details on what is happening there.
That looks a bit grey.
That one has been thrown in.
Well, 5% is still a pretty substantial move. Another major company that's seeing a pretty substantial move is Grifols. This is a deal that I'm a little obsessed with here because they recently, basically Brookfield just recently walked away from Grifols. This is a major Spanish company as well. They are now talking about a €1 billion euro debt placement after that walk away. The shares are rising about 6.4%. One of the big concerns is that this is a family-owned business and they were going to be taken private. Now it looks like to kind of tread a little bit of water, they are having that debt move. Something that the market, by the way, really likes. 1.3 billion, I should be specific.
We mentioned that NATO story a few times this morning, so let's get to that shortly. Coming up on the programme, we will discuss new NATO goals on equipment production, national defence spending and more. That's next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
As
we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
19 minutes into the session, I'm struggling to get excited about the numbers that you see on the screen in front of you. The Kekar is up a little bit more. The takeaway today is that luxury names are actually doing fairly well. There is a China read across. Actually, basic resources aren't having a bad day either. But we are, I think, looking for a sense of direction. The Fed cut rates yesterday, or at least the market priced in the Fed cutting rates yesterday. We're waiting to see what the ECB has to say a little bit later on. Let's turn our attention to a conversation we've been having with the outgoing US Treasury Secretary, Janet Yellen, talking about a softer global oil market and saying that may present an opportunity to target Russia's oil revenue. Janet Yellen has been speaking to Bloomberg's David Gura about ongoing efforts to impair President Putin's ability to wage war in Ukraine.
We never preview sanctions, and we've constantly been tightening our sanctions on Russia. Our overall aim is to impair Russia's ability to continue conducting this brutal war, to try to deny it the military equipment. It needs to be able to do that, and we've taken a variety of steps to do it. But we have been focused since the outset on Russian oil revenue. It's a critical component of the Russian budget, and we've been looking for creative ways to try to reduce Russia's revenue. One of the most creative policymaking things that I've been involved at during my career occurred here in Treasury when we were able to devise a way and convince our allies to join us in this, imposing a price cap on Russian oil, which was a way of avoiding price spikes when the war started for oil, and actually succeeded in keeping Russian oil flowing into the market. So we continue to look, of course, over time, while these sanctions have been effective, Russia has invested a lot, its own fleet of ships, to carry its own oil. We cut it off from allied ships, new insurance that have been costly to Russia to have to make those investments. Now, what's unusual about this moment is that the oil market seems to be well supplied.
Prices are relatively cheap.
Prices are relatively low. Global demand is down. And there really has been an increase in supply. American firms have stepped up. We have vastly expanded oil production. OPEC countries like Saudi Arabia have excess capacity at this time. So the global oil market is softer, and that creates possibly an opportunity to take some further action.
US Treasury Secretary speaking to Bloomberg's David Gura, talking about how the oil industry is feeding the Russian war machine, turns our attention to what is going to be feeding the European war machine. NATO said to be potentially planning new targets for member countries to produce more weapons, vehicles, ammunition. This is the group weighs the new Trump presidency and how Russia's invasion of Ukraine will ultimately end. There's talk potentially of the NATO target going to 3% of GDP. That discussion appears to be increasingly live. Bloomberg's Ollie Crook joins us around the table in London this morning. Walk us through how Europe spends more and what it spends it on.
Yeah, so listen, guys, this is sort of interesting because we're thinking about this all in the context of a great many of sort of things within Europe. Just left Brussels, where we're talking about the financing of defense, and really they're trying to throw a lot of things at the wall and really see what sticks at this point, because we don't really have a cohesive approach of how this defense spending is going to be boosted and what it's going to look like concretely. So one of the proposals now being discussed by NATO is boosting that target to 3% from 2%. We're bearing in mind that most of these NATO countries only hit 2% basically this year or very, very recently, and then getting something close to quotas or targets in terms of actually producing this kind of hardware and military hardware and these capacities, air defense, ammunition, tanks, all of these sorts of things. And why 3%? The U.S. spends 3.5% on NATO, and of course now we have Trump coming in. It has been one of his big gripes with the Europeans, and frankly something that he's been completely validated on, at least in his first term as president.
Where does the money come from?
And this is going to be the big question. As we talk to the finance ministers of the last couple of days, you have some resistance, obviously, from the sort of traditionally frugal nations, from Germany, from the Netherlands. But it's interesting. We also spoke to the Danish prime minister, who, admitted to being very sort of frugal in the past, but actually open to putting things on the table. I think the problem is you have all these different concepts, this 500 billion euro fund. You have these special vehicles where potentially electively countries could join into a sort of bond issuance for collective defense. The problem is for these countries, in order to get them on board, they need concrete proposals in terms of what this money is actually going to be spent on. Is it going to be a sort of joint sort of air defense system? Is it going to be maritime? Where are these things going to actually go? There needs to be a concrete plan to hook into. And that is, I think, where next year we might get something sort of interesting from the Polish Council presidency of the EU, because they really want to make sort of defense number one on their agenda. And as we know, we spoke to the finance minister yesterday, already their spending next year to NATO is going to be about 5%, the highest of anybody in the alliance.
Yeah, it'd be interesting to see how much the planning around who does what is coordinated or not, Ollie, on that front. And in terms of where they buy it from, if there is a plan, as some have suggested, like Mario Draghi, for example, that these things should be done in a bi-European way, if there is a plan for that, is there going to be enough supply within Europe?
So this is certainly a plank of basically what the competitiveness regime is going to be, but also in terms of defense is trying to get that spend up. But if you just look at the market caps of these companies, I mean, Rheinmetall, after a 540% surge since the war in Ukraine, is a sub-30 billion euro company. We have, Raytheon is at 160 billion. You have Lockheed at 120. So they have a lot of work to do, and they need to figure out basically how big these order books need to get in order to actually boost that capacity. We went to Norway to go to Kongsberg, where they actually expanded that missile factory earlier this year. That plan began before the war in Ukraine. So this is really a long-term plan.
Yeah, we certainly heard from the UK government as well, talking about spending more on defence and their plans there, and linking that to the economy, just as the Europeans look set to do then. Oliver Crook with the latest on NATO. And sticking with defence, don't miss our exclusive conversation. In fact, Oliver bringing us this tomorrow with the CEO of the German defence company Hensoldt. That's tomorrow at 8:30 UK time, ahead or in a link to the Capital Markets Day and strategy update.
What we're going to do next, we're going to talk about a conversation I had with the CFO of the travel tech company Flix, talking about why the company didn't go public earlier on this year and took the private option. It's all part of the conversation around the CFO series we've got. That is tonight. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. Can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Ready? Go.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade about 30 minutes into today's session. Green on the screen when you look at the stock market, but the real juicy bit is what's going on in the Swiss economy at the moment. The S&P cutting the policy rate by a whopping 50 basis points down to about 0.5%. The estimate was to 0.75%. They are already going on saying that they're prepared to intervene in currency markets if needed, which, by the way, you are already seeing some major weakness across the Swissy against the dollar, the euro, the pound, even the Japanese yen.
The problem is that they've got a real issue that they keep cutting rates and the Swissy keeps getting stronger. And the reason it keeps getting stronger is the political turmoil that we're seeing elsewhere. And this is obviously having a major impact on Euro Swissies, which is what they really worry about. So they've got to do intervention. It looks like they're back to that playbook. They can keep cutting rates if the market isn't responding. So what else you do? You intervene, you support the market. But we're back to the playbook.
Yeah, and as you can see on the screen, as you were mentioning, Critty, the euro strengthening as a result of this decision. Euro Swissy rising 0.6%. The SNB, no stranger to throwing us curveballs, were the lines I read from Venram this morning, and this seems to be the case once again. They surprised us. They surprised us with a 50 basis point. They surprised us investors with a 50 basis point increase to mark the start of the tightening cycle in June 2022. Then in March of this year, the cut was a big one, and it came earlier than expected. So, and this is a new president at the Swiss National Bank. Doesn't seem to be adverse to giving the markets a surprise.
But what is it? So they've cut by 50 basis points, so that's a surprise. So you're also getting a shock reaction in some ways. The market wasn't positioned for 50, though some people have been talking about it. How long does that move last? And is this a reaction to the 50, or is there a reaction to the stronger language, willing to be active in the FX market? Which of these two factors, or the combination of both, are moving the currency? I suspect it's probably a little bit of both. The 50 is obviously a surprise, but how long does that 50 last? Say we get some more chaos in France. Does that undermine the 50?
I was literally going to say, is this an insurance cut at the end of the day? Is that what that extra 25 basis points is? In that if you do get that bid for the kind of political hedge that you were referencing with the Swiss franc, is this the extra dry powder that a lot of economists, including Bloomberg Economics, have said needed to be there in case come January we need that extra room to maneuver?
And we've talked a lot about the weakness in the inflation in Switzerland, and they're talking about how this is being driven mainly by domestic services. So reminding us that given we talk a lot about the international context of the Swiss franc and their decision making, there is this domestic driver.
They're at 50 basis points now. They're not far away from zero.
They did half of what they had left, if zero were the lower bound, which we know it isn't.
But it isn't. They've already indicated that isn't the case. So really interesting move. Looks like the S&P is going to be having to step up on the intervention front. That certainly seems to be the narrative coming out this morning for the 50 basis point surprise being delivered. We'll see what the ECB has to say a little bit later on. Let's turn from central banks to capital markets. Tonight sees the European premiere of Bloomberg's latest episode of Chief Future Officer. For this episode, I went to Munich to visit the CFO of the travel tech company Flix, which has become the leading long-distance bus operator in Europe and in the United States. If you've never seen one of those green buses, which maybe you have here in Europe, if you're thinking about the United States, they own Greyhound. Now, earlier this year, the company pivoted from a planned IPO and instead sold a 35% stake to private equity giant EQT and Kuhne Holdings at a valuation of over $3 billion. Now, this is just yet another example of private markets winning out over public. So I spoke to the CFO, Christophe Debus, about how that decision came about.
We have always seen an IPO only as a financing event. It was never a strategic goal. Public markets, they don't forgive. It's all about performance, and you have to live up to your promises. We have introduced the culture, we deliver or we over-deliver.
Then the company dramatically changed course. Postponing the IPO, Flix sold a 35% minority stake at a reported €3 billion valuation to investment giants EQT and Kuhne Holding.
What led to that pivot? What was the decision-making behind it?
The markets were not ready for IPOs. At the moment, IPO markets are so depressed that you only do an IPO, I would say it, if you really have to. The opportunity came up, and we had the opportunity to speak to EQT and Kuhne and realized that for the time being, that's the much better option. And then we worked very, very hard to deliver that deal.
So it was not one or the other, and one was a bad option. It was just two good options, and I just chose the better one.
Think an IPO could still be a possibility?
You know, we built that company for generations. I think this is really a company which has the potential to be here still in 100 years. And on that path, I think one day it will end up at the public markets. That's my conviction.
One day that will happen. But Andre talking about the fact that he chose the better option in the short term. That seems to be the private play at the moment for so many businesses. So it's really interesting. There's another example of a company that has decided to go down the private route. If you want to get more on this, obviously, you can watch the entire episode. Plays out for the first time here in Europe, 6:30 p.m. tonight.
That's really interesting, that decision-making, the thought process as to why you go public or you go private. And that takes us nicely into our next conversation. Let's bring in Silvia Viviano, who joins us from UniCredit, who's head of equity capital markets at UniCredit. And Silvia, we wanted to talk to you about IPO markets, about equity capital markets within Europe. And we were just hearing that conversation with Flix there, talking with a CFO who's had to make that decision. Do you go down the private route or do you go through the public markets? And the decision they made in that case was that public markets were just not ready for IPOs. Has that changed? Is that changing through the latter part of 2024 and into 25?
Hi, good morning, everybody. I think listening to Christophe, Flixbus is a perfect example of what we saw in 2024. Private company, very performing excellent, very well, delivering in terms of results. But then you have two options, and actually they've been lucky enough to have two options, right? That's actually is a testament of the quality of the company. And the reality is that investors were there, but probably they were questioning on some of the aspects of a company which is still young and growing a lot. And at that point, the reality and Flix is just one example where we saw many other cases that were basically at the same level or were doing the same process of Flix. They decided to actually to go private and to wait for more conducive capital markets environment and, let's say, judgmental investors willing to actually invest and take a bet also on high growth companies. The reality is that it doesn't change really through the second part of 2024. When we talk after summer, reality is the election, the U.S. elections, they were there to actually put a pause on the IPO market. And so we haven't really seen an increase or a pickup of activity in the IPO market in the second part of 2024. We do see, however, a bit of pickup in terms of pipeline for 2025.
Okay, that's interesting, because so we're talking here still about a cycle, Sylvia. I wonder if there's something more structural going on here as well, and that is the rise of private markets. And we've been talking a lot at the beginning of this week with people who said public markets are just not very good at allowing businesses to invest for the very long term, and therefore a number of companies either going private or staying private longer if they have a requirement to do a lot of investment in infrastructure, in decarbonisation, for example. Do you think that the public markets are just being found wanting right now?
I think you mentioned something very relevant, and I think it's a bit of a cycle here, in the sense that we are in a situation where, because investors and the market is so demanding, so they want more paper to come, especially from Europe, they want more companies to get listed, but then when we go and we present good candidates, they start questioning a lot of the characteristics and some of the key metrics and of the expectation business plan of the company, etc. So, private markets instead has been much more diligent in trying to analyze and actually work alongside the management to understand better the future and the business plan of these growing companies. So I think we just saw a split, which I don't think is a structural change of the public markets. I think it's something we saw in the past.
Yeah.
But it's just a matter of the result of what happened to the recent IPOs and some big trades that didn't perform very well.
Sylvia, what can government do? What should government do to make this better, to make this work in public markets? In the UK, we've heard messages coming from the Chancellor of the Exchequer, Rachel Reeves, talking to regulators, trying to put a more growth-focused emphasis on what they are delivering. Do you think this is a problem that regulators need to solve rather than investors?
I think it's the first time in having worked in the equity capital market for so many years that I do see an alignment of all the different public and private, let's call them forces, in terms to try to find a solution in Europe for the equity capital markets. If you think the report issued by Mario Draghi on the European competitiveness, the reality is that he says we need to be careful because here we have the risk of slow agony. And I think it's very, it's a very precise point. The government and actually all the public bodies, they need to do something in order to try to, prevent the lack of innovation that we have in Europe, the fact that we have so many different capital markets available. They definitely need to do something at a broader level, at a higher level, in order to facilitate and make the European capital markets more open for business and actually, more, let's call the investors friendly and issuer friendly. That's for sure a must.
Sylvia, if not London, and if not the United States, then where? And basically where I'm asking here is, does Paris, does Frankfurt have a fighting chance in terms of creating kind of these more liquid markets that you're referring to? Are you starting to see that appetite? For a moment, I felt like we did in Paris, and then it kind of disseminated. Where do we stand on European capitals becoming that next IPO hub?
I think every single European market right now, Frankfurt, Paris, Milan, Amsterdam, they are really trying to make, I don't want to say rules easier, but to make it, again, easier for the issuers and also more appealing for investors to invest. As of today, Kriti, if you ask me, I don't think anyone has yet achieved the final result. So is there any specific capital markets in Europe which is winning? I don't see the result yet, but yeah. I do see for sure a concerted effort in order to try to achieve this.
So Christine Lagarde was talking about this the other day. She was talking about just how many venues there are in Europe that you can trade equity. Is that the other problem as well, that we just simply have too many? If we talk to Euronext, if we talk to the London Stock Exchange Group, should we be saying to them, why aren't you consolidating? Should government be pushing for consolidation? Don't we just need a few big exchanges here in Europe that maybe have the heft and the capability to be able to deliver a capital markets that Europe needs?
It's a very tough decision. It's not an easy answer to give, but my personal perspective is that, we need to make things easier. And in Europe, it's too fragmented. And investors, especially US investors that are used to a much simpler system and infrastructure in the US, I think they can see the difference and they struggle a bit. We are basically fighting or competing among each other within the European Union, and for sure we are not helping ourselves.
Silvia, we're going to wrap it up there. Thanks for joining us. Perfect timing. Really appreciate it. Silvia Vivano, Head of Equity Capital Markets, joining us from UniCredit. What are we going to do next? We're going to go to Paris. We're going to get the latest on the political impasse. We are waiting a new Prime Minister. When does Emmanuel Macron announce a name? We think by the end of play today. Is that realistic? We'll find out next. This is Bloomberg.
Suppose I want to buy a computer, but I want to have AI in my computer. I want to be really up to date. Do you have AI in your computers yet?
No, not yet, but is coming soon. And we think this is going to be one of the largest transformations in the PC industry in decades. What will be possible starting this summer is to run large language models in AI PCs, which means that what today all of us are doing in the cloud, where you use any of the applications that you can, you will be able to do it locally. And what this means, which is why we think this is important, is it will be much better from a cost perspective, because running models in the cloud is expensive. It will be better from a security perspective, because you will be able to use the model with your own data locally without having to upload your data to the cloud, and you will be able to do it anywhere in the world. And also for applications where speed is important, where latency is important, you will be able to do it locally much faster. For example, in gaming, where the game needs any resource the computer have, it will be a much better model. So it's going to be a big change starting this summer.
At the same price, too?
Slightly higher price, but if we look at the increase of price versus the increase of value, not comparable.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome back to the opening trade, 8:46 in London. We see very modest gains across European equity markets today, and we're waiting for crucial data out of the United States, PPI. We also get the ECB rate decision. We'll come to that in a moment. US futures down by 0.2%. Within the last half hour, we've had a decision from the Swiss National Bank, so let's get to that conversation. The SNB has surpassed economists with a 50 basis point cut to interest rates this morning, so surpassing those economists' expectations. Bloomberg's Jana Randau is in Frankfurt monitoring what's going on in Switzerland, though. And Jana, how do you read then this SNB decision? Because it clearly has weakened the Swiss franc, and they've suggested that they're prepared to intervene in currency markets further if needed.
Yes, definitely proves that the SNB is always good for a surprise. It was that way under the old president, under Thomas Jordan. And it is true for Martin Schlegel, who recently took over and is about to chair his first press conference, actually. So indeed, a bold move, especially considering that the policy rate now is at 0.5%, so not very far away from that zero line. And that has to do, of course, with the fact that inflation once again proved weaker than expected. The SNB predicts inflation to be just 0.3% next year on average. While that's still in line with their targets, so the S&P has a quite wide range. It says inflation needs to be under 2% and positive, so 0.3 in that sense is still in there, but of course at the very low end. So a bold move make an entry for Martin Schlegel for sure.
Yeah, absolutely. Jana, is returning to zero or even negative rates potentially on the table? Is that something people are talking/thinking about?
Yeah, I mean, there are some economists that have raised that chance. Markets are looking, at that zero threshold. That being said, of course, a lot will depend on what's happening around Switzerland. It's a very open, trade-reliant economy, so export demand is very important for them. But getting back to the policy thing, negative rates is a very controversial tool in Switzerland, especially after the last episode. Which was a very long period of time with very, very negative interest rates. The S&P got a lot of pushback from banks, so that tool is not very well liked. And you mentioned it, they would probably go for currency interventions instead. The statement says they're ready to do so if necessary. So that's probably their first choice if they have to go that way.
Yeah, are interest rates having any impact on the currency? I keep seeing the S&P cutting rates and I keep seeing the currency go stronger. Is intervention really therefore the only tool they have at their disposal if they seriously want to limit the appreciation of the franc?
I mean, it's the one move that lasts you longer because it's something that you will do and repeat, right? An interest rate cut, of course, has implications on the currency, but with time, that change goes away as markets reprice expectations and ask themselves, what is the S&P's next step? So if you want a lasting impact in market, then you need to make that happen somehow. And surely interventions is something that keeps you in the market for longer.
Yeah, I suspect the market is now wondering what else is in the toolbox and how deep that toolbox is and how wide-ranging it could ultimately be as well. Be interesting to watch how the S&P responds over the next few weeks and months. Jana, thank you very much indeed. Jana Rando joining us out of Frankfurt. Staying in Frankfurt, the ECB holding its final policy meeting of the year, widely expected to deliver fourth rate cut of 2024, another 25 bips anticipated. Lizzie, that albeit it seems to be in the price right now. Set us up for a surprise. Lizzie Burden, by the way, in Frankfurt.
Well, I can't promise you, Guy, that the ECB is going to follow in the footsteps of the SNB today, but I think they'll be thinking about it at least. Think about everything that's happened since the last meeting. You've had the collapsed governments in France and Germany, Donald Trump being re-elected, the euro area very much in the firing line for his tariff threats, but none of that is likely to derail the cut, but it will likely muddy the forecast. So we'll get numbers out to 2027 today. I'd expect them to lean more on scenarios than a base case, given all of the uncertainty. And you could see downgrades to growth and inflation because the outlook has darkened since the last meeting. You'll remember that PMI in November. And at the last meeting, you had Christine Lagarde saying that the inflation risks were tilted to the downside. Maybe we actually see that in the statement this time. Further out, you've flagged this, Guy. There is this big debate about where neutral lies and whether to go below it, how far to go below it. Economists reckon rates will settle at 2%, traders reckon 1.75%, but it all comes down to this debate of how much monetary policy can actually do to deal with Europe's economic woes, as so bluntly laid out by Mario Draghi. You've got poor productivity, a lack of skilled workers, a lack of financial integration. How much can cutting rates do about those issues? The likes of Isabel Schnabel would say not much, and that's why the Hawks reckon they don't need to, or they should start cutting rates. They should stop cutting rates sooner.
All right, Bloomberg's Lizzie Burden joining us outside the ECB from Frankfurt. We thank you so much. We'll have full coverage of that rate decision due at about 1:15 p.m. London time, followed, of course, by ECB President Christine Lagarde's news conference at 1:45 p.m. London time. As we were speaking to Lizzie, we got some headlines crossing the Bloomberg terminal. Romania and Bulgaria getting the EU nod to join the Schengen border zone at a time when there's real division within Georgia, within Romania, to do that, to get closer to the EU.
What's Schengen zone? Germany in September, I think, backed away, put extra border controls in place.
There were border controls. Yes, certain borders of Germany didn't look very much like they were in Schengen. So, yes, whilst this might be a sort of step forward on that integration story, there are many reasons to suspect that things get difficult. We'll watch geopolitical developments in the Middle East carefully.
Its value maybe has been downgraded a little bit. We're, of course, watching what's happening with French stocks and bonds. Investors, of course, are waiting Emmanuel Macron's decision for Prime Minister. Who's it going to be? We're expecting a decision by maybe the end of play today. Is that realistic? Bloomberg's Caroline Conan in Paris. Are we finally going to get a deal tonight? Is the left wing going to back a candidate? What are we looking at right now?
Yeah, that's what we're expecting. In fact, the President Emmanuel Macron is in Poland today for a state visit, and we expect the name of this new Prime Minister by the end of the day when he comes back from Poland, probably before the 8 o'clock news in France. But I think the most interesting political shift that we've seen over the past few days is really the slow death of this NFP left-wing alliance with the socialists, the communists, the Greens, going to meet with President Macron, showing they're willing to compromise. The first secretary of the Socialist Party, Olivier Faure, appearing on French media over the past few days, saying they don't want to block the situation anymore. What they're asking is that the new prime minister doesn't use the 49.3 article in the constitution to bypass a vote in parliament in the future. Of course, the head of the far left, Jean-Luc Mélenchon, who's refused to take part in those discussions, has called for outrage, saying that the socialists have no chances if there are snap elections next year to be elected because they need the support of the far left. And in fact, Macron has kind of been reaching out as well, saying that he's hoping there will be no parliamentary elections until the end of his mandate in 2027, kind of meaning that, you know, not scaring the socialists who may think about not being re-elected without the support of the far left.
And just briefly then, Caroline, who are the names, which are the names that we're watching for? Have they evolved?
We still have François Bayrou, the head of the centrist Modem Party, 73-year-old, currently the head of some independent planning advisory that was created by Emmanuel Macron during COVID. The good thing about him is that obviously he can also talk to the center-left, even though Olivier Faure, the first secretary of the Socialist Party, has said that it would not necessarily be the best choice because it is a bit of continuity of Emmanuel Macron. But Bayrou is also not at odds with Marine Le Pen because he has been supporting the proportional system in parliamentary elections rather than the two-round system, which is something that Marine Le Pen has been asking for years. And of course, you still have the name of Bernard Cazeneuve, the former socialist prime minister of François Hollande, always coming back. We already spoke a lot about him last summer. Maybe he would be a bit more convincing, a bit more like a rupture from Emmanuel Macron for the socialists who are showing they're willing to compromise.
Caroline, thank you very much. Bloomberg's Caroline Conan with what we need to watch out for today. And that's certainly one of the things we're watching for an ECB rate decision, watching for the naming of a French prime minister. And we understand that comes today from our reporting. Also watching for the president-elect and what he's up to.
Yeah, potentially going to the New York Stock Exchange to ring the opening bell. Not confirmed, not public, but potentially.
That's huge. This is my stock market. It sort of signals a relationship with the stock market that many in the market are looking for. I am going to support this. If we start to see problems, maybe I will figure out a way of making that work well as well. The opening trade is wrapping up. The Pulse is coming up next. Big day ahead. Plenty of coverage as well. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Does not. They tend to send the ambassador. So maybe the invitation has come, but would Xi Jinping go is the big question. And the feeling seems to be unlikely to do so. I mean, for a start, sitting outside in the cold in January in Washington for several hours, a la Bernie Sanders with his gloves. But also, do you want to be in that audience not knowing, as you say, to the unpredictability of Donald Trump? What does Donald Trump say in the minute? Well, you're sitting there as the Chinese president. Perhaps he starts riffing on the Chinese economy or tariffs or something. You just don't know what he might say or do in that moment. And then how do you respond as the Chinese president sitting there? How do you react? So it's politically risky to do so. So even if the invite comes, he'd be unlikely to attend. But what it does show is that there are some ways that perhaps the administration of Donald Trump, despite the threat of tariffs on China and other countries as well, and to continue to penalise China economically, there might be a way that he's looking to have some kind of dialogue.
Yeah, I was going to ask you, so the last time they met was 2019, but also, you know, he's basically trying to China bash on tariffs, but at the same time making him friendly. So there are a lot of people say that we're not going to get the tariffs that Donald Trump says because he wants a deal. Does this point towards that, or is it too early to say?
Well, China, like other countries, is pretty astute at reading the room. Again, on tariffs, we can see Donald Trump using that as a negotiating tactic, a political tool with Canada and Mexico. So he wants something from these places. And what can you deliver that kind of allows Trump to claim a win? Trump can say, I got this from you, therefore I don't need to hit you so hard on tariffs. And we know that Xi Jinping and Donald Trump, they have met before, and they've had kind of a bit of a rapport. They seem to admire each other in different ways. You know, they've had quite warm interactions when it's in person, and Xi Jinping will probably be hoping that maybe if they can meet together at some point before too long, he can have success in that regard again. So you're going to have probably a multifaceted relationship between China and the US, not just as simple as hitting each other on trade.
Roz, thank you so much. As always, Roz Matheson there, Bloomberg's EMEA News Director. Now it's Stock Markets with Ian Steely, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. Ian, I mean, we have to talk, of course, about the US. We have a lot to talk about Swiss franc, but going back to China, there's also a bit of a boost in some of the Chinese consumption markets because there's expectation of more stimulus, fiscal stimulus, monetary stimulus coming in the next couple of days. How do you play China?
I think it's quite challenging because ultimately, if you hadn't had the election, and if you saw everything that was going on at the moment, you would probably be quite excited about the opportunities in China. There's obviously, we do seem to have had a bit of a step change over there. Maybe it was a bit more piecemeal on the policy front earlier this year, now getting a bit more concrete, really pushing that. But obviously, as you've just rightly pointed out, we don't know what's going to happen next year when it comes to tariffs and the relationship between the US and China, which does make it a little bit more challenging. I think what we're looking at is that even though Chinese government bond yields still look low, it seems an environment where they're going to stay low. So for me as a fixed income investor and sort of looking at global portfolios, you probably still actually want to, even at these low levels, own some Chinese government bonds.
Okay, what do you do with U.S. government bonds? Again, we had the inflation print. Does this change everything at once Donald Trump's in charge? So is it very difficult to read what kind of economy the U.S. will be left with?
So again, if you looked at the fundamental data today, it does now look like the Fed is going to be cutting rates again
December
next week. But I think the question mark is going to be more around, firstly, the dot plots and what does the committee think they're going to do next year, and then of course the press conference. And obviously there's going to be a lot of questions to Jerome Powell at exactly what it means. And the problem is he just doesn't know. And he doesn't know what the sequencing of the events is going to be. He doesn't know how, what the size of the tariffs are going to be, how much fiscal is going to come. So in a sense, they really just do need to look at the data today, and the inflation data. Yeah, maybe it's ticked up a little bit over the near term, but I think they'll take comfort from yesterday's shelter, owners' equivalent rent components, which that was the area they were concerned about. That seems to be coming down. They still have some issues around softness in the jobs market. If I was them, I think this is the time, though, to set up the pause and let's see what happens over the next couple of months.
So what does it mean for treasuries?
It means for treasuries is you probably still want to have treasuries in your portfolio because it's really an insurance. So yes, there is possibility of big fiscal spending, but when you think about where Treasury yields are versus what could happen if things slowed down, we know they could go a lot lower if there was a problem in the economy and the Fed did need to react. And then really to get Treasury yields a lot higher from here, you probably need to be talking about the Fed hiking rates next year, and that again seems a long way off. So I think we're probably range bound for now. I think there's other opportunities in other parts of the fixed income market, but actually just having some Treasury duration as portfolio insurance, I think that makes a lot of sense at the moment.
Ian, there's a lot going on with Frank. I mean, this is a big market move. What is this? Is this the beginning of a trade war? Because actually, the new president wanted to show that he's firmly in charge, and actually he's not happy with the level of the Swiss franc, or is it just a mechanism of the same thing?
I think if you look at the Swiss economy, it's slowing. Inflation is low. I mean, in a sense, they've victim of their own sort of issues. They have a very limited number of meetings throughout the year. Do you want to get in front of the curve now rather than try and play catch up? And I think that's a question that is probably going to ask to Christine Lagarde later as well for the ECB. Obviously, the Swiss National Bank have got ahead of her in that sense. So I think it's more around actually just looking at their own economy and thinking about what they need to do to ensure that they don't continue to slow.
I mean, do you don't think that they want to try and break the cycle of actually the Swiss franc really seeing as a haven, given all the geopolitical concerns?
Possibly, and I think that's one of the problems. I mean, the Swiss franc versus euro has been relatively strong over the course of this year. So that that is something. But look at the inflation prints in Switzerland. You look at the economic data. It warrants them moving lower.
Okay, and we'll talk a lot more about the European Central Bank shortly. Ian Steely, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management, stays with us. Coming up, the ECB set to lower rates for the 4th time this year. Bloomberg Economics sees cuts at every meeting through to March next year. We'll be live in Frankfurt next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. Now, the European Central Bank is holding its final policy meeting of the year today and is widely expected to deliver its 4th rate cut of 2024. Well, Lizzie Burden joins us now from Frankfurt for a preview. Lizzie, set us up for the decision.
Well, consider the risks, Francine, that have emerged since the last ECB meeting in Slovenia. You've got the collapsed governments in France and Germany, Donald Trump re-elected to the White House, and the threat of tariffs very much leaving the euro area in the firing line. But none of that really is expected to actually induce a 50 basis point cut today. Only JP Morgan, of the economists we surveyed, sees that happening today. But what it could do is encourage a dovish tilt in the language, in the statement. Specifically, they might remove this line that says they'll keep policy rates sufficiently restrictive for as long as possible. What it could also do is really muddy the forecast. We'll get an update on those today out to 2027. I'd expect them, therefore, to lean more on scenarios rather than a base case. And you could see downgrades for growth and inflation. We remember those PMIs in November. We remember Christine Lagarde at the last press conference saying that the inflation risks were tilted to the downside. Maybe we see that actually in the language of the statement this time. Further out, the debate really is about where neutral lies and whether to go below it and how much to go below it. Economists reckon 2% is where rates will settle. Traders reckon 1.75%. But this all comes down to really the limits of monetary policy. How much can interest rate cuts do about the big problems highlighted by Mario Draghi? Poor productivity, a shortage of skilled workers, the lack of financial integration. The likes of Isabel Schnabel, the hawks on the Governing Council, therefore make the argument that they need to stop the cuts sooner because there's not much that rates can actually do.
Lizzie, thank you so much. Lizzie Burden there with the very latest from, of course, ECB headquarters in Frankfurt. And we'll have live coverage of the ECB decision, a news conference starting at 1:15 p.m. UK time. Now let's get back to Ian Steely from JP Morgan Asset Management. Ian, I mean, again, it's going to have to be a skillful press conference trying to, you know, it's like walking a tightrope. It's basically not saying too much about what U.S. policies could look like, knowing that they could change the European economy completely.
Yeah, no, I think so. And I think, I mean, there's a couple of things that I'm specifically looking for, because it does feel like they're going to go 25 basis points. I would like to see how they deal with the language about keeping policy restrictive. I mean, I think, obviously, the more recent evidence is that inflation is coming down. Is it more seasonal at this time of year? You know, how will it look in the first quarter? I think there's questions around that. But when, you know, as Lizzie said, when you look at the PMIs, when you look at the data, you know, Europe's in a tough spot. So is policy restrictive? But if you sort of take that out and too quickly, you know, why aren't they going 50 basis points will be a legitimate question. And then the next question for Lagarde, which I'm sure will come up during the press conference, is did they discuss 50? Yeah. And ultimately, you know, how many people felt that 50 was the right sort of move? So I think it will be an interesting to see how dovish the message is.
But they're worried about services inflation. They're also worried about wage negotiations that start in January.
They are, but actually when you look at some of the wage negotiations, and if you look at the negotiations that happened relative to sort of 2021, the new negotiations, yes, they were high, but actually if you look at the new negotiations that were more recently done, say 22, 23, they're not as high. So it does look like the wage negotiations are coming down as inflation is rolling over. And then you just look at the underlying economy and it does look soft. And I think that will be the bigger concern. Obviously, it is a more challenging, you know, getting everyone on board, getting all 20 countries on board to be more aggressive is going to be a challenge. But I think it's going to be 25 today, and then what is the trajectory? That's what the market will be focusing on.
Ian, a couple of other things. I mean, when you look at political France, it's a mess. We still don't have a prime minister. Maybe we get something by today. Germany is also going through a very uncertain election. How do you play fixed income in Europe?
So I think actually you sort of park
Stay away.
France. No, not Europe in general. Actually, if you think about it, what's happening, and you see the softness in Europe, actually European duration does make sense. But you look at the countries where you're more constructive on the fundamentals. So areas like Spain, areas like Italy get a bit more carry in Italy. You know, Spain's now trading through France, but you'd argue is a better credit at the moment. I think that's how you play the European story. But actually, when you think about what's happening in Europe relative to, say, other parts of the developed markets, the argument for owning European duration makes a lot of sense.
All right, Ian, thanks so much, as always, for joining us. Ian Steely there from JP Morgan Asset Management. Coming up, U.S. inflation remains above the Fed's target of 2%, but of course investors think it will not stop the U.S. Central Bank from cutting next week. We discuss all of that with Jim Bianco, president of Bianco Research. That's next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics. Makes you wonder how politics might play out.
Welcome back, everybody. Now, investors still widely expect the Fed to cut borrowing costs by a 1/4 percentage point next week after the latest CPI figures rose in line with expectations. Well, I couldn't be more happy to discuss all of this with Jim Bianco, president of Bianco Research. Jim, I have a million questions on crypto, on treasuries, on everything in between. But what are the charts that you're looking at to see what equities do next?
I think it's going to be pretty much inflation and interest rates. The equity market is basically benefiting from stable to low interest rates right now. If interest rates were to start up, I think that could pose a headwind for it. And for what's driving that is the inflation data. And the inflation data came out yesterday, and it wasn't bad enough to stop the Fed from cutting rates. So it looks like we're on board for a rate cut next week.
Okay, so this is one of the charts that we picked out that you sent through, and it basically shows America's stock market worth twice its GDP. I guess, is there a Trump trade? Has that already largely been done because it's underestimating inflationary pressures, or does it unlock animal spirits?
No, I think the animal spirits have been unlocked. And what the chart shows is that the U.S. stock market is richly valued, or maybe even fully valued at this point. I don't know if you want to say overvalued. And historically, valuation is an important tool, not because it's a timing tool. The market could go up a lot next year, but it tells you that over the next several years, if you're buying an overvalued market, you should expect lower returns. And a lot of the metrics that you look at when to try and measure the lower returns, you might be looking at a stock market that could be returning you 6 or 7% in the next decade or so. But people are used to 20%, and that's a problem right now.
Look at that. That's the charts. What about when you look at a lot of the onshoring that's been happening? Does that change under Donald Trump, or are we going to see more volatility?
No, I think that, as far as when Trump comes in, the concern you would have is that you're going to see stimulus. You're going to see extension of tax cuts. Yeah. You're going to see deregulation. You're going to see an economy. The U.S. economy has been growing quite strongly. Mm-hmm. That's going to get extra stimulus from a Trump administration. Not to mention that you might see some form of tariffs, and we all debate on how much and where, that could be inflationary. That is going to make a very strong nominal growth economy. Yeah. The concern has always been, why is the Fed cutting rates in this environment? It doesn't need it. And the concern is all they're doing is fostering a more higher expected inflation.
Yeah, so on tariffs, how and when? Look, overnight, CBS was reporting that actually Donald Trump invited Xi Jinping to his inauguration. I'm not sure quite how to take that. Is that means that, I want to negotiate, so hold on for the tariffs? Or is it just psychological kind of, war gaming?
That is the $64,000 question in the United States. What is his plan? Is it gambit? Is it that tariffs are leveraged to get something else? Or does he just want tariffs? I'm in the camp that it's leverage, that he wants to threaten tariffs as a punishment for not giving him a deal on something else somewhere down the line. Ultimately, we'll get deals and we'll get less tariffs. Others make a reasonable argument that no, we'll get less deals and more tariffs. That's going to be the big question. Inviting Xi, I think, to the inauguration, I think puts it more in the deal camp, that he wants to talk and he wants to cut a deal with them.
So the other bit, I mean, you know, markets are really trying to figure out passive versus active, and then you overlay like all the credit and the private markets that are flying through the roof. This is another chart that you picked, and it's basically, you know, showing that's tougher for passive to beat some of the active bonds. Let's bring up the charts, and you tell me what it means going forward.
So what it tells you is, in the table, is that 90% of equity managers cannot beat an index over, say, 3 or 5 years. That is what we all know, and that is not controversial. But in fixed income land, it's a much different metric. It's more like 50-50. So active managers in fixed income, just going into the game, have about a 50% chance of beating an index. And the argument that has been made now that bond yields are 5%, and as I said, maybe stocks are going to return you 6 or 7 with a little more volatility, that bonds are in the game. The best strategy is a passive approach with equities and an active approach with fixed income.
Yeah, where'd you buy in fixed income?
Well, that's the that's the professional.
To get that right.
Yeah. The professional manager will do it in there. Right. But I mean, where do you buy in fixed income? I like mortgages. I'm not so keen on corporate bonds. I'm a little bit defensive on interest rates because I think that they could go higher. But remember, even if you're defensive on interest rates and you think that they can go higher in yield, lower in price, there's such a big yield right now that you'll still get a positive return out of the bond market.
All right, so Jim, thank you so much. Jim Bianco there stays with us. We discuss tariffs in China after hearing more from our exclusive interview with the U.S. Treasury Secretary Janet Yellen. That's coming up shortly. Also, a good conversation on crypto. I'm looking forward to hearing Jim's thoughts on what the Trump administration can mean for crypto, for Bitcoin, but also blockchain. This is Bloomberg.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is
indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. U.S. President-elect Donald Trump reportedly invites Chinese President Xi Jinping to his inauguration, despite fresh tariff threats against Beijing. Traders cement bets of a Fed cut next week after inflation rises in line with expectations. Plus, the ECB is set to cut rates for the fourth time this year, loosening constraints on the region's struggling economy, while the Swiss National Bank surprises with a half-point cut. Now, U.S. Treasury Secretary Janet Yellen has urged the next U.S. administration to maintain the dialogue channels that she reestablished with China. Well, she spoke exclusively to Bloomberg's David Gura on the eve of what's likely to be the latest round of economic and financial talks between senior officials from the two nations.
We've put in place tariffs now. They're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
Well, that was U.S. Treasury Secretary Janet Yellen speaking to us exclusively. Now, still with us, Jim Bianco, president of Bianco Research. Jim, thank you so much for sticking around. We're talking about inflation, Fed, some of the expectations that you see out there. So it's clear that, it's clear, you believe equities are priced to perfection. What do you do with gold?
Gold is an interesting one because it's having a great year, and a fun statistic for you. This is the first time ever that the S&P 500 and gold will be up 25% in the same year. Now, why is that? Because I think the market is signaling to us it's worried about too much monetary stimulus. No. That's got the gold guys going. It's got the stock guys excited that too much monetary stimulus means liquidity. So in this environment that the Fed is cutting rates and still talking about monetary stimulus, I think that the bid for gold will continue and it'll keep going.
But is it also a breakaway from dollars? So longer term, do you see a lot more central banks trying to challenge, I guess, the supremacy of the U.S. but by buying not treasuries, not dollar?
Yeah, I mean, there's, especially the BRICS, they're going to continue to try and break away from the dollar. The problem is they're going to have a problem doing it because the rule of law, the deep capital markets, the derivative markets, the $5 trillion a day of dollars that trade, you can't replicate that with gold. You can't replicate that with anything else. You can't replicate that with a cryptocurrency. So, it's our currency, your problem. The problem, it's been the old line about it. That's true, except, the U.S. has got to be reckless about having that privilege that they have.
I mean, crypto has been flying.
Yes.
Right? Since Trump got it or was elected. What happens to crypto?
Well, it's been flying because we finally got regulatory clarity. It has been a frustrating mess in the crypto space, under the Biden administration, trying to understand where things are going to go.
Right.
Hopefully, the bull case for crypto, that it has moved higher, is now that we've got regulatory clarity, the innovation will be unleashed in that Bitcoin, Ethereum, they will become more than just stores of value, more than medium of exchange, that a whole new financial system could be built, on alternative financial system can be built on these crypto rails. And now that they can start finally doing it, because it's just 2 years ago that they were jailing developers because they were building products that the regulators didn't like. So hopefully they can let that innovation go now.
Jim, Bitcoin, 100,000. What's the limit for Bitcoin at this point?
At this point, I don't think it's got much more on upside until you start to see other ideas come to play. That there's crypto rails that you could wind up seeing, that we could see it as a medium of exchange. We could see it as some kind of a use case to coming in. Now, maybe those use cases will come. It could continue to go higher from here. But for right now, it's really stalled out for the last month or so around this $100,000 level.
I mean, regulators had concerns about it being, used for money laundering and dirty money. Do those concerns just disappear with the new administration?
No, I think those concerns are still there, but, and let's accept that they're correct. It is used for dirty money and money laundering, but it's a small percentage of the world. It's still, the traditional financial system is the majority of the way that dirty money is moved. There are ways within the crypto system that they could find compromises if regulators want to work with the developers, and hopefully they will, and then they will find a happy medium.
Jim, between all of this fiscal spending possibly in the U.S., the deficit is huge. How much more can the U.S. take of it?
Well, the deficit's 6.5% of GDP, and that has been typical of what you would see in a recession, but we're in the 5th year of a recovery. Since I'm here in London, I'll say, we're waiting for the Liz Truss moment. We're waiting for the moment that the bond market says enough, and that they put their foot down, and then it gets really hard to sell bonds. It doesn't look like it's on the horizon immediately, but if we continue with these deficits at this level, there will be some point like that in the future.
It wasn't even talked about during the election campaign, which is for me, it was very surprising as an outsider.
It was for me too. And in fact, even the few times it was ever brought up, people said, nobody cares. Well, you got a better question, is where they were with it right now. And part of the reason it wasn't talked about, because it seems like both candidates were into deficit spending. If Harris had won, it would have been spending. Trump won, it's tax cuts. So the deficit is going to stay. The hope is that the Doge Committee, headed by Elon and Vivek Ramaswamy, are going to produce these efficiencies that will help to bring down the deficit. In theory, it's possible, but in reality, call me skeptical.
Yeah, when you say like a Liz Truss moment, is this a big bond auction that just goes wrong because people don't want to buy it, or what does it look like?
I don't know if it's going to be that acute, that immediate event. But what it would be is interest rates keep going higher, and it becomes more and more expensive for the government to fund. Ultimately, what happened in the Liz Truss moment is when UK gilts went up enough, they broke part of the financial system, and liability-driven investing, LDI, broke. So if interest rates go up enough, the old adage is they go up and something breaks, then you say, why did it break? It's because rates are up. Well, what will get rates down? You got to bring the deficit under control. That is more of an evolving kind of thing, as opposed to it's acute on one day that we can't get an auction done. But that still could be very disruptive, too.
Jim, when you look around the world, where else do you invest? If you're the UK, this depends quite a lot on the personal relationship that the prime minister of a country at a specific time has with Donald Trump. So is it impossible to park your money, as it were?
Well, the dilemma that global investors face is the story is well known in the U.S., and the story seems to be very positive in the U.S., and you're going to pay huge multiples and premiums to buy the U.S. The story's a little murkier in Europe. Germany and France don't even really have governments at this point, but you're also getting a much better deal. You're getting those at much lower valuations. And so I think that, for the value investors of the world, they should probably be shifting away from the U.S. Europe looks like a very good value play right now. Sure, it might struggle a little bit in the future, but the growth momentum players will probably continue to stick with the U.S. But I kind of like the idea of the value play in places like Europe.
Okay, Jim, so good to have you on. Thank you so much for joining us. Jim Bianco, they're president of Bianco Research. Now, Adobe has given a disappointing annual sales outlook. This is one of the stories that we're watching out for. Full year revenue about $23.4 billion, just shy of average analyst estimates. The outlook also underscores worries that the software giant could be disrupted by emerging AI-based startups. Pre-market down 10%. Coming up, This is going to be fun. Award-winning chef Jason Atherton joins us to discuss his new restaurant and the future of the dining experience here in London. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back, everyone. Now, Michelin-starred chef Jason Atherton has opened a new flagship restaurant on Savile Row, the famous home, of course, of British tailoring. Now, it's meant to be a symbol of his culinary ambitions, but also his love of sartorial craftsmanship in the UK. Now, he's opened restaurants all over the world, but says he wants this one, called Row on 5, to be his legacy. Now, let's discuss how he plans to do it and the challenges in the sector with Jason, who joins me. Now, a little bit mean, actually, putting good food at like 9:41 a.m. London time.
It's my menu, but I'm still looking at it going,
it's
pretty tasty.
Not bad. Jason, congratulations. I mean, it's never easy opening, like, a big restaurant, an important restaurant. Why this restaurant and why on Savile Row?
Well, Savile Row, but 295 years has never been an official restaurant on the row. I've always shopped there when I started to do okay for myself and could afford to shop on the road, so I started to be able to go down there, got to know a lot of the tailors really well, and then we got approached for a small space, an old tailor shop, which we can then convert into what we call a legacy restaurant. We really wanted to be a restaurant what would stand the test of time, what would go hand in hand with the row. We use Bennett & Witch leather for our menus, we use Cat and the Dandy for our uniforms for the front of house staff, we use just up the road there, our guy does all of the smoking jackets for people that go outside, Daniel Henderson. So we really try to embody everything what's great about Savile Row. And I think, the most proud thing for me, I think when we can walk away one day and, pass it on to the next generation, that Row on 5 will become, it will go down hopefully it will go down as an iconic restaurant.
It's difficult, I imagine, because restaurants, there's a lot of openings. I mean, you're one of the most celebrated and famous chefs, but I guess tastes are fickle, or popularity of restaurants are fickle. What's the secret sauce of doing a restaurant that lasts?
Do you know what? I mean, if there's no such thing as the secret sauce in our business. Some restaurants just catch the moment right. We've opened 4 restaurants in the last 5 months. We opened a restaurant called Sale in Piccadilly Circus, which is going gangbusters. It's really affordable. It's a beautiful space. Wine's under 50 quid. And the whole of London's just taking it to its heart. It's been well reviewed, and and it's just going gangbusters. So there's, you know, although our industry has not been invested as much in the last few years, certainly I believe the future's bright for London. I think that we will continue to develop restaurants world class, and I think London will always be one of the best cities in the world to dine out. It's just, you know, navigating restaurants and guests' taste buds are really tricky, and you've got to live and breathe the restaurants.
Jason, because tastes are changing, because people like go to restaurants and consume differently than they did pre-COVID or even.
Oh, you know, as you get older, I'm 53 now. As you get older, you know, when we opened Pollen Street 14 years ago, Pollen Street was an instant success. It was absolutely so busy, and all of a sudden, you know, you 2 generations of customers have gone through your restaurants, and you know, you start to see other restaurants opening up and what they're offering and stuff, and it's very easy to stay with something when it's a success story, unless it's iconic, like Berners Tavern, which is one of our iconic restaurants, which stays exactly the same and is fully booked every day, and that's you know, that's an iconic restaurant. But you know, it's City Social here in the city also. That's pretty much stayed the same in 11 years. It's been fully booked. People love it here. It's our, you know, one of only 2 restaurants in the city with a Michelin star. And it's, yeah, so we're very lucky.
Do people go out more but spend less?
Exactly what's happening, Francine. So all the data, all the research we did, people were going out more today. I'm talking like the new generation of diner. They want to go out more. They want to spend less. So the restaurants what are adapting to that are the ones what are winning right now. And that's got to be the key. And the key is to have really good landlords. That's number one, the lesson number one. You have to work with your landlord. The landlord's got to be, if he doesn't favour what you're trying to do, then you'll never succeed. Because if you're going to get aggressive rent increases every 5 years, then the concept eventually will just fade out and fall over. You know, you've got to make sure you keep on top of staff costs. Staff costs are one of the biggest killers in our industry. You know, with Labour announcing that our minimum wage goes up again in April, although we're very adamant to pay our staff as much as we possibly can, as fair as we can. We also have to stay in business, right? And with spending going down and costs going up, there's got to be a point where the tipping balance doesn't work anymore. So you've got to really work hard. It's the classic 4-25s, right? So 25% food and beverage, 25% overheads, 25% staff costs. And in the good old days, it was 25% profit. Now those margins are squeezed down to like 11-12% if you're lucky. So it's tough in our industry right now. But you know, if you love it and you're passionate about it, guests feel that. And it's what I do. It's in my veins. I love cooking. I love making people happy. And that's what we do.
Is it easy to find staff, or is it
much better? Post-COVID was horrendous, like
because
really
people stayed at
horrendous.
home, or did they just? Or
I just think it took a long time for the country to wake up, right? I think globally. I mean, we had a really successful restaurant in New York City called the Clock Tower, had 1 Michelin star, and we just couldn't get it working again after COVID. So we just had to shut it. It was, you know, there was a lot, you know, the pandemic, you know, killed a lot of our industry off, but we're a resilient bunch. You know, we all came back fighting, and I feel now London's as good as it's ever been. And we hope that, you know, Three Darlings in Chelsea, what we opened up just a month ago, 2 months ago, sorry, on Pavilion Road.
What's been your hardest moment? Like, is there a day where you kind of thought, actually, you know, I love what I do. It's like you live and breathe this, but is there a day where you kind of thought, actually, I'm not getting enough support from government, I'm not getting enough support from landlords?
I think the hardest moment was we were about 3 months into the pandemic, and we just got furlough, which you're also paying the tax and stuff, right? So we got furlough for the staff, which was the most important thing. Then me and my wife had enough, because she's my business partner as well as my life partner, we had enough money in the bank to last us 18 months. A lot of people fired their staff, laid them off, got rid of them, and let the government take care of them. We took the stance of, we're going to pay everybody, we're going to pay all of our staff till the money runs out, and just hope and pray that we've done the right thing. And I've got to say, 3-4 months in, you know, you've worked your whole life, right? From coming to London at the age of 16, washing pans, you know, learning to be a cook with no desire to be a Michelin chef. That was never the plan. It was just to learn to cook, go back up north and open a little restaurant and support my family. That was the plan. Obviously, life had other things in store for me. And then you think, my God, I've worked tirelessly, 6 days a week, 18 hours a day. We've finally got success. We live in a nice home. Kids go to a lovely school. We've got some form of success, and it's all just been taken away. I mean, look, it was not, it's no one's fault. It was what it was, right? But it was a really hard pill to swallow. But, you know, after a couple of days of, you know, self-pity, people had it much tougher than me. People were passing away, not seeing their parents and all that type of stuff. So I just gave myself a kick up the bum and got back on the horse and and we came out the other side, and we survived, right?
But you're still, I mean, this year you're opening 5, but you had to also close 3 spots,
We closed a lot.
right?
I mean, at one point we were like 22 globally.
Yeah.
We're down to 12. I think it's probably enough.
Okay.
We have, you know, the plan is over time, row on 5 in London, which I'll spend predominantly of my time, and then row on 45 in Dubai, our 2 Michelin-star restaurant, which got it in 6 months, which we're deeply honoured. I'll be spending a lot of my time between Dubai and London, working on those 2 projects. We won't do too much more because I really want to cook.
Dubai seems like the happening place right now.
Yeah.
Right? Is it buzzier than London in the restaurant scene?
Yeah, I mean, it's hitting the point. I think it's going to hit saturation point. A lot of people go thinking the streets are paved with gold, a little bit like London was 10 years ago. And you've got to really work it. I worked really hard, tirelessly, to be part of the local community, to get the customers to support us. I spent a lot of time in Dubai making sure that our cuisine, our service standards were on point. And it worked, you know, it worked. And I think that's the key to everything at the moment. If you give your guests a good time, great service standards, great food, they will come back.
Jason, thank you so much for joining us tonight. Congratulations on the new opening. Jason Atherton, their chef and restaurateur. Now, coming up, we talk sports and Saudi. Saudi's sports strategy pays off as the kingdom is officially announced as a host for the 2034 FIFA World Cup. So we're live in Riyadh with the reaction next, and this is Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Well, Elon Musk has become the first person to reach $400 billion in net worth. Now, the most recent catalyst was an insider share sale of his privately held SpaceX, which boosted Musk's net worth by roughly $50 billion. Now, Tesla shares also rallied to an all-time high yesterday, pushing its chief executive's fortune to $447 billion. Also, South Korea's president is set to face another impeachment vote over his shock declaration of martial law last week. The opposition filed their second motion against Yoon Suk-yeol after he made a defiant speech earlier today in which he tried to justify his decision. Now, the vote appears more likely to succeed as the president loses support within his own party. And of course, Saudi Arabia will host the 2034 World Cup, marking the return of the world's biggest sporting spectacle to the Gulf region for the second time in 12 years. Now, the decision is being seen as a major victory for Crown Prince Mohammed bin Salman's push to improve the country's image and attract tourists. Now, for more, let's get straight to Bloomberg's Matthew Martin in Riyadh. Matthew, thank you for joining us. So how does the World Cup fit into Saudi Arabia's broader plans to diversify the economy, promote tourism, and grow its soft power?
Hi, Francine. Yeah, look, I mean, as you say, the Saudis over the last 4 or 5 years have been on this huge push to start hosting these big global events, and the World Cup is really the pinnacle of this strategy. We've already got the Asian Cup coming here, Asian Winter Games. We've got the Expo 2030, and now we're going to have the 2034 FIFA World Cup, and it's all part of this plan of promoting tourism. They want to find all these events that are going to bring people into the country to try and convince them that Saudi Arabia is not the sort of country that you might have read about in the news, and they want to do that to bring in more foreign capital, more foreign tourist spending into this country, because for years there has just been money leaking out of the country because there's been more Saudi tourists going outside and spending money abroad than there have been foreigners coming in. And so this is all part of the push of trying to correct that, and also trying to boost this soft power projection of the country and change people's perceptions internationally of what Saudi Arabia is and what the sort of culture and society that Saudi Arabia stands for is.
All right, Matt, thank you so much. Bloomberg's Matthew Martin there in Riyadh. I know we'll talk about this for a very long time to come. Now, a reminder that we'll have live coverage of the ECB decision and news conference. That starts at 1:15 p.m. UK time. Then at 6:30 p.m., the European premiere of Bloomberg's latest episode of Chief Future Officer. Guy Johnson speaks to the Chief Financial Officer of the travel tech company Flix, which has become the leading long-distance bus operator in Europe and the U.S. And Bloomberg has also learned that the U.S. President-elect Donald Trump is scheduled to ring the opening bell at the New York Stock Exchange later today. Now, Trump has often tied the stock market's performance to his very own economic policies, so we'll have plenty more on that throughout the day. Up next, Bloomberg Brief with Manus Cranney in New York, and this is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Good morning from our global headquarters in New York. I'm Menace Granny. Welcome to Bloomberg Brief. Let's set that agenda. Big tech's big break. The NASDAQ 100 hits a record 20,000 as the data cements the Fed's rate cut bet. But first, we're counting down to the ECB, expected to make its fourth cut of the year as inflation nears 2%. Save the date. President-elect Donald Trump invites China's Xi Jinping to attend his inauguration ceremony. That has infused a little bit of risk on in some of the Asia trades, but to ground zero here in the United States of America. Post-CPI, we're 95% lock probability of a rate cut next week in December. So we are just seeing a little bit of heft in the U.S. equity markets. You can see we're just coming off those highs yesterday. What a magnificent number for the NASDAQ, the composite, 20,000. We're 21,750 on the 100, and the Russell just giving back an eighth of 1% this morning. You've got to ask yourself the question, though. The dividend yield, it's a little bit lower than BBB, and that is a warning shot. The bond market, we've got PPI today. Of course, this is all about building towards the final PCE, and that's expected to come in at plus 0.3% on the PPI. They turned up yesterday. Demand for the 10-year auction was the strongest since 2016. Loretta Mester has a warning for the market, though. You need to rethink 2025. Inflation progress has stalled out a bit. We'll talk about those rates and those markets in just a moment. We're also keeping an eye on a couple of stocks for you. Adobe falling after a disappointing annual sales outlook. Uber stock, it's on the up this morning. Management making some upbeat comments at an industry conference, up nearly 4%. And Broadcom, it's dipping slightly before it reports today. Those earnings will be after the bell, down by 0.4%. And in just a few moments, we'll start the conversation about markets with Elsa Lignos of RBC. And later this hour, Bob Elliott of Unlimited joins me. Let's test his exuberance. First up, it is the ECB. They're set to announce the last rate decision of 2024 this morning. Let's get to Frankfurt. Lizzie Burden is with me. Lizzie, there was a great deal of debate a couple of weeks ago. It was going to be 50 basis points. Consensus is around 25. How dovish will Lagarde be? Maybe that's the more prescient issue.
It definitely is, Manus, because think of everything that's happened since the last meeting. You've got the collapsed governments in France and Germany, maybe less fiscal tightening for the ECB to rely on to help fight inflation. Donald Trump re-elected, and the euro area very much in the firing line when it comes to his tariffs. So yes, there are some who say that 50 basis points will be on the table today, but it looks unlikely. Maybe, as you say, you'll hear a change in the language, specifically the part of the statement that last time said they'll keep policy rates sufficiently restrictive for as long as necessary. Maybe they tweak that language. Also, those risks might change the forecast today. They're looking out to 2027, lots of uncertainty to factor in, so they'll probably rely on scenarios rather than a base case. But further out, the debate really is about where rates settle. Do they go to 2% as economists think? Will they go to 1.75% as traders think? Really, it comes down to the extent monetary policy can actually help with Europe's economic woes, as so bluntly spelt out by Mario Draghi. Isabel Schnabel would make the argument that actually this is why you need to stop cutting rates sooner.
The debate is this, of course. Look at the language that's been used towards Mexico and Canada so far by President-elect Donald Trump. He hasn't started on Europe yet, has he?
More because of the inflationary impact of domestic US economic policy, slowing down Fed cuts, creating a divergence across the pond and actually feeling it more through the currency. There again is a split on the ECB Governing Council as to whether the growth risks from tariffs are more important than that inflation risk. But again, this is something that should come out in the press conference, but Lagarde not going to want to wade into politics.
No, she's definitely not, but it's probably an unavoidable one. It seems to be a feature of a lot of the central bank press conferences afterwards. Lizzie, we'll speak to you a little bit later on. Lizzie Burden at the ECB headquarters. My guest this morning is Elsa Lignos, Global Head of FX Strategy at RBC. Elsa, good to have you with us. We seem to have come off that real high pressure point for 50 basis points. Same question to you. How dovish does Lagarde probably be today?
I think she's likely to continue the tone we've heard in recent press conferences, which is cautious. Certainly a lot of people are expecting downward revisions to both those growth and inflation forecasts. But at the same time, as you mentioned in your intro, there's a fair degree of uncertainty around 2025, both how much we're going to see from Donald Trump, but also what we're going to see both pre and post-election in Germany in terms of fiscal support. And I think there's room for both of those to change things quite materially. And so I'd be surprised if Lagarde wants to commit herself to any particular path.
Do you think domestically, when you look at Europe, I mean, the inflation numbers ticked up ever so slightly. Growth was a little bit better than estimated. Do you think we've skirted the worst? Do you think we've passed peak chaos economically and politically in Europe?
Well, there's some interesting signs of stabilization. If you look at the Q3 data, signs of private consumption turning positive. We've been seeing that for a couple of quarters now in the UK. It's definitely an encouraging sign to see that happening in Europe. And at the same time, you've also got the prospect for some fiscal support as you look ahead to 2025. Certainly, it's hard to see the French government undertaking any kind of fiscal consolidation, and the German government, as I said earlier, likely to be fiscally easier. But skirting the worst, I mean, a large part of that will depend on the external shocks as well. There's a wide range of views in the market as to how much Trump may implement and what the knock-on impact on Europe will be.
Are you any closer to the point of where you would say buy euro dollar?
I think it'd be premature, in large part because it's a negative carry trade. And, Manus, we've spoken so many times over the year, we started the year in a position where we had 108 for euro dollar, so we were never real euro bulls, and we remain in that category. But equally, I'm not in a rush to make calls for 95 or 80. There's certainly scenarios where you can see euro dollar testing parity, even trading below. But also, I think what we've seen in the past 2 weeks with all the negative news that's been thrown at the euro and the fact that we're still trading where we are today, the hurdle for seeing downside in euro dollar is actually pretty high.
And I think that's it. The market is so reluctant to be long of euro because there are a quantum of risk going into 2025. Look, if we pivot to the Fed, the CPI was sort of green-lit the probability of a 25 basis point cut from the Fed. But again, let's just invert the language there. How hawkish a cut do you think we'll probably get from the Fed?
I mean, it doesn't feel like they need to be particularly dovish at this stage, right? When you look at the prospects for 2025, and again, we were already in the camp pre-election that the Fed was going to have a higher terminal rate. Our forecast was for 4 to 4.25. We remain with that forecast post-election, and certainly there are a number of things that Trump could do that would be quite inflationary in the U.S. The backdrop, the growth backdrop, for some, it's concerning. You know, when we look at it, actually, there's still some fairly positive signs of growth there. Putting it all together, you could actually make the case for the Fed skipping this meeting. I know nobody expects that. Certainly, the market's not priced for it at all, and the Fed don't like to surprise. But really, if you're starting with a blank sheet of paper, you kind of question, you know, do we really need much easier policy at this stage?
But that's what Loretta Mester basically, you know, cautioned the market yesterday, where she said, you need to start to rethink 2025. I mean, they may well, look, we may well get a Wall Street Journal article between now and when the event happens, but that sort of helps us. But Loretta Mester said, rethink 2025. Disinflation has stalled, and you possibly need to rethink the cuts. And therein lies the issue for the dollar, because it's a recalibrating of the dollar to a pause. I take it that the dollar would welcome a pause.
Absolutely. I mean, I think if you look at the dollar right now, the fact that it's that higher yielder in G10 relative terms, that means that you're comfortable just sitting in a long dollar position, in spot terms at least, because you're not paying carry. In many cases, you're earning carry. And so I think that supports those long dollar positions out there. The biggest risk for the dollar really looking ahead to 2025 is if we see an unexpected slowdown, economic slowdown in the US. And then, of course, you do see euro dollar a lot higher, dollar yen a lot lower. That's just not a base case forecast at the moment, and we have to see signs of it happening before trying to position for it.
The one thing that I was surprised on reading your notes is that you say almost everybody you speak to is long dollar. Fine, that's consensus, but not in huge size. And yet, you know, you talk to the other parts of the market and they say, you know, this dollar will exhaust itself by December because on a relative basis, it is so strong. What kind of underpositioning are you actually seeing?
Well, I think there are a number of people that took some profit on their long dollar positions and may also have been positioned in options rather than spot. And so either those structures rolled off or they hit their targets and restructured. So at the moment, it feels like people heading into the end of the year and nobody expecting massive dollar move into year end. A lot of people have actually lightened up on risk quite materially. And I'm not saying that means necessarily the dollar explodes high from here, but it just gives you some sense for the balance of risk. I mean, if we do see Trump threats, for example, on tariffs hitting between Christmas and New Year's Eve, you could potentially actually see a fairly sizable dollar move as people kind of rush to put those positions back on.
Yeah, well, a lot can happen between now, as you say, and New Year's Eve. And then look at the S&P and Canada. They went for jumbo, back-to-back jumbo cuts by Canada, and the S&P certainly took the market by surprise. Elsa, we've run out of time. The clock clicked down. Elsa Lignas there of RBC. We're counting down, of course, to the ECB decision later today. There are stories, other stories trending on your Bloomberg terminal. This is what we've got for you. As I say, the Swiss National Bank has cut its interest rate by 50 basis points. It was a surprise move. The decision is aimed at defending the franc and fighting low inflation, but also may use up precious ammunition, leaving the central bank limited options if borrowing costs reach zero. South Korea's opposition Democratic Party files another impeachment motion on President Yoon, with a vote expected on Saturday. In an address, he vowed he would fight until the last minute to defend himself over the declaration of martial law, but more ruling party members saying they'll support impeachment moves against him. Large US banks will have to cap their overdraft fees at $5, or an amount that covers their costs and losses. Under a new consumer protection rule that's been vigorously opposed by the industry and by Republicans. The rule will aim to reduce the average $35 charge Americans face when they go overdrawn at their bank account, according to the CFPB. Coming up, will Xi Jinping attend Donald Trump's inauguration? The president-elect seems to hope so. More on the story right here on Bloomberg Brief. Context matters. Good morning.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely.
To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The Fed decides.
The consensus seems to be that you need a beat on payrolls, an upside surprise on CPI, and the Federal Reserve will hit pause.
Yeah, but it's a pretty high bar.
All this seems very predictable.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
People feel good about where the economy is. Demand is obviously pretty strong.
If there were black clouds on the horizon, what would they be?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Hey, it's Bloomberg Brief. I'm Manny Scranny in New York. Good morning to you. We're less than 6 weeks to go before the inauguration of President-elect Donald Trump. And he has extended an invitation to attend to his Chinese President Xi Jinping. That is according to a report from CBS News. Let's get to our senior editor, Bill Ferries. He's in Singapore. Bill, I've got to ask myself, is this a real political olive branch, a tactical play, or game theory writ large? What do you make of this invitation? Could it even happen?
Well, you know, for starters, it could be an olive branch after a campaign in which Donald Trump repeatedly said he'd throw a lot of tariffs on China from day one. But I am having a hard time imagining Xi Jinping, you know, sitting in a folding chair on a field in Washington on a cold January day, watching President Donald Trump take office and potentially go off script and announce tariffs, insult China, or anything else like that. Remember, President-elect Trump just this week online called Canadian Prime Minister Justin Trudeau the governor of the state of Canada. So the political risk for Xi Jinping would be very high. On top of all that, foreign leaders do not attend U.S. presidential inaugurations. We look back in State Department records all the way to at least 1874. It hasn't happened. No Chinese leader, of course, has done that either. So I think it's highly unlikely. But if you wanted to look at the glass half full, you know, possibility, sure, it's an olive branch to China. It's obviously going to be a rocky road in the weeks, months ahead of the Trump term.
I think it was a slightly more interesting nuance this morning. You've got the Ministry of Finance basically saying, we want to manage our differences. We're willing to increase our talks with the U.S. on trade. That's perhaps a little bit more significant, isn't it? Because that's about incremental moves to engage.
Sure. I mean, I think any sign that these two nations, the world's two biggest economies, are going to have some kind of a functioning relationship, and that it's not just going to be about you know, a public relations war, announcements on Truth Social or on X, you know, that's going to be positive. If you remember the early start of the Biden administration, Anthony Blinken, Secretary of State, met with his Chinese counterparts in Alaska in March 2021. That didn't really go that well, but it at least got leaders off to some talks that were able to continue.
Look, let's just wrap up with the FBI. Christopher Wray is set to announce that he's going to resign. This, of course, clears the way for Kash Patel. This is pragmatism, really, isn't it, in terms of the leader? He was appointed by Trump, but it's not exactly what you call the most wonderful relationship.
Yeah, you got to remember, he came in after Trump fired the predecessor, James Comey, over the Russia investigation. So Christopher Wray was Trump's pick. He and his supporters started to sour on Wray for a variety of things, including FBI going into Mar-a-Lago after Trump left office, looking for classified documents. Wray also helped prosecute January 6th protesters that Donald Trump has said he may pardon on day one of his presidency. So it's been a bad relationship. I think this does take away that distraction. Donald Trump can appoint an interim FBI director while Kash Patel goes through the confirmation process. So it does give Trump a clean slate there.
Okay, well, as Christopher Wray said, it's the best way to avoid dragging the Bureau deeper into the fray. Bill, thank you very much. Great conversation this morning with Bill Ferris. Coming up, another story that we're watching on Bloomberg. We've learned that President-elect Donald Trump is scheduled to ring the opening bell at the New York Stock Exchange later today. Will that match up to Madison Square Garden? Coming up, NVIDIA steps on the gas. More headcount in China for the automotive project. What's it all about? We'll tell you right here on Bloomberg Brief.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Politics to the world of business. Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bloomberg Brief, I'm Dennis Cranny in New York. Time for the front pages. This is what we've got for you. Headlines from around the world. First up, the Associated Press to France is expected to name a new prime minister today. At issue on the search are both policies and personalities. Those in circulation are reportedly names that have been around for years, but an outsider could always emerge from the pack. Next up, also on the Associated Press, the IEA saying oil markets face a glut in 2025, despite last week's decision by OPEC Plus to delay the supply increases. It forecasts an oversupply of 1.4 million barrels a day if the current plan to proceed goes ahead. Global consumption is expected to grow by 1.1 million barrels through 2025. And Bloomberg leads with NVIDIA adding more staff in China to focus on AI-driven cars. It added 200 people to beef up the team. The world's second most valuable company will end the year with about 4,000 people, up from 3,000 at the start of the year. Let's get to our executive editor for Global Tech, Peter Elstrom. Peter, tell me this. What is this push into AI autos by NVIDIA? We know they've got restrictions around some of the chips they can sell into China. So what does this do? What's this push about?
Yeah, it's a good question. Manus, of course, it's not a surprise that NVIDIA is expanding. Its business is booming right now, especially because of this very strong demand for its AI chips in particular. So it is adding staff in many, many different markets. But as you alluded to, China is one of those markets where it can't sell its most advanced AI chips. So why is it doing this expansion? Well, the key here in the China market is they're working on technologies for autonomous driving. China, of course, is the biggest auto market in the world. They've also been a leader in EV cars. They're trying to push into autonomous driving, and NVIDIA is trying to beef up their engineering capabilities there so that they can serve that market. And not coincidentally, they also want to have these strong relationships with Chinese companies if there is some warming between the U.S. and China, and they're able to get back in there with the AI chips where they make most of their money at this point.
I just wonder what Elon Musk will be saying to President-elect Donald Trump about the prospect of Jensen Huang getting involved in autonomous driving in China. But look, this is a company which is in growth mode. Workforce has grown by, what, 25% this year, and they'll probably expand by the same level next year. Where will they go for growth in the headcount?
Well, NVIDIA more broadly is really riding this tremendous boom in AI. So they're a little bit concentrated with their major customers right now. They're selling those AI chips into the hyperscalers, especially Google, Microsoft, Amazon in particular. So that's really their big area right now. But they want to expand beyond those core four into other markets where some of these upstarts want to develop AI models. They want to get access to NVIDIA's most valuable AI chips. So Jensen Huang has been accelerating their pace of innovation. They're trying to come out with new generations of chips really every year now to add to that market and to serve this insatiable demand for the AI services that people are appearing to have at this point. Their customers still need to show that these services can turn profitable. It's a big question overhanging, I think, the AI market right now. Some of them have made progress, like Microsoft in particular, and some have a long ways to go. So we'll see how this plays out. But right now, NVIDIA and Jensen Huang are really focused on that golden opportunity.
Okay, Peter, great to have you with me this morning. That is Peter Elstrom on the very latest for NVIDIA. Quick snapshot of the markets. Bob Elliott is standing by. We'll find out just how exuberant he is. At the moment, you're stepping back by an eighth of 1% on stocks, and you've got the dollar slightly on the back foot this morning. We'll take you through the headlines and what Bob Elliott believes you should be doing with your portfolio from Unlimited.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past. to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Menace Crenny. Let's set your agenda. Big techs, big break. The NASDAQ hits a record 20,000 as the data cements the Fed's rate cut bets. But first, we're counting down to the ECB, expected to make its fourth cut of the year as inflation nears 2%. And save the date, President-elect Donald Trump invites China's Xi Jinping to attend his inauguration ceremony. Will he accept? It would be rather unprecedented. Let's have a snapshot of markets. Right now, there's a little bit of optimism, which has faded in the overnight. I can tell you the actual NASDAQ comp went through 20,000 splendidly yesterday. Obviously, NASDAQ futures trading at 21,743. So we're giving back 0.25%. And there is the cash, as you can see, last night at 1.77%. Where's the valuation here? You know, the NASDAQ's trading at a P of 29. The S&P is at 22. Of course, they're two very different things. But the NASDAQ's still at a 5-year average. Roll it over. Have a look at the bond market. We're counting down to PPI today and then obviously to PCE and the Fed's decision. It's expected, if you listen to Loretta Messer, you got to rethink 2025. Inflation progress has stalled out a little bit. So yields rise ever so slightly. We're counting down to the PPI. As I say, my guest is Bob Elliott, CEO, CIO of Unlimited. Bob, good morning to you.
Good morning.
I mean, we're breathless with record highs, more than 50 record highs this year on the S&P 500. There is this sense of euphoria, animal spirits. Calibrate your exuberance right now.
Well, a lot of folks are worried because, you know, prices keep hitting highs. As you noted, valuations are relatively elevated from any perspective. The issue is the valuations really only matter when you start to get enough central bank tightening to roll over the cycle. And we're getting exactly the opposite. In fact, what we're getting right now is a perfect combination of pretty good growth conditions and central bank easing. In the U.S. in particular, where growth is 2 to 3%, and the Fed keeps cutting. But really globally, we're seeing the same type of conditions play out, where global growth is pretty stable at 3%. Inflation continues to be a little bit elevated, and yet central banks have already delivered 100 basis points of cuts and are plan to cut another 100 basis points in 25.
And here's what you say. The Fed will keep cutting, and Powell will cherry pick. I love this. He will cherry pick some other data to prove that monetary policy is very restrictive. I mean, is it restricted? Given market exuberance, one would say policy is not restricted. Given the math, you would say it is restrictive.
Well, there's something like 500 academics sitting at the Fed running models and saying that Fed policy is very restrictive, not looking at the fact that asset prices are hitting all-time highs, that spreads are at all-time lows, that the economy is running at 2 to 3%. The unemployment rate is pretty low by any reasonable measure. And the reality is Fed policy restrictive or not? It's not a theoretical question. It's not a model question. It's an empirical question. And the empirics are very clear. Growth is pretty good. Inflation is still elevated. And yet the Fed will Chairman Powell will go up there on the stage, next week, and he'll say, hey, look, very restrictive policy, we need to bring rates down.
You should go and have a bit of lunch with Mark Rowan then over at Apollo, because he sat down with Johnny and he said it was one of the most expensive jumbo rate cuts that we've had. You're right. We saw the SMB do a shock 50 basis points. Canada, back-to-back 50 basis point cuts. So you are looking at this, whether it's not synchronized rate cutting 2024, but do you get the same level of cutting in 2025?
Well, right now, what's priced into markets is essentially the same magnitude of cuts that we've seen in 2024 playing out again in 2025. And that's a pretty aggressive set of cuts, 200 basis points total of cuts. The last time we had cuts of this magnitude, the financial crisis and the 2000 bust. And certainly conditions look nothing like the financial crisis and the 2000 bust.
But then we started this year with a very, very high bar in terms of what we thought was going to be delivered in cuts. We're not ending the year anywhere near that. But continue the thought. So over the 2 years, 200 basis points, and you haven't had that since GFC. Right. You don't think we'll get that?
Well, I think we probably will get that, because I think central banks are looking at what they believe to be a neutral rate. Look at the ECB. They're saying the neutral rate is 2% or 1.75%. Well, if that's what you believe the neutral rate is, then you've got a long way to go. And the problem is that the impact of the cuts on the real economy, it doesn't occur instantaneously. It occurs in the financial markets. That's what we're seeing in the financial markets, pushing to new highs. But the effects in the real economy are going to take some time to flow through. Those 200 basis points of cuts, we're going to really start to see the effects in 25 and 26. Getting all that monetary easing and that stimulation into economies where inflation is still above the mandate across basically all of these economies.
This goes back to what kind of inflation you end up getting. And I like what David Kelly had to say yesterday. We've got rich world inflation and we have poor world deflation. I just wonder, from a portfolio concept, you talk about airlines, hotels, cars, that's the rich inflation. The deflation will be obviously in shelter, perhaps in some of the energy areas. So how do you take that bifurcation in inflation and overlay it onto portfolio?
Well, I think the main thing you want to focus on is the source of inflation, which is really nominal spending, particularly by households. What's driving that is their nominal wages. And so if you start at wage growth, whether you're looking at the US or Europe, for instance, you continue to see wage growth that's running at 5%. That 5% is translating into spending, nominal spending of about 5%, into economies that have, in the European context, very weak productivity, very hard to get, to basically produce. If you're spending on a 5% nominal basis and you have zero productivity, there is embedded inflation pressures in the economy. And that's exactly what we see. I wouldn't necessarily call it rich world inflation. And
well, that was Mr. Kelly's quote, not me.
Mr. Kelly's quote. I'd call it more the services versus production divide, where services inflation is driven by wage inflation, and that's remaining elevated. Goods inflation has come down, but a big part of that is the backside of the bullwhip, where you had the COVID-related challenges, production challenges. Now you've gotten supply to come back online. Now we're seeing a normalizing. We're starting to see a normalizing even in the goods side of things. So if you have elevated services inflation and normalizing goods inflation, that's adding up to seeing a rise in inflationary pressures, which is basically exactly what we're seeing whether you're looking at the U.S. or the European context.
So given that backdrop, you would also, it's interesting you say that bank lending is back at GFC levels, or sorry, recession-like levels. So if we extrapolate what you just said, which is further rate cuts to come, another 100 basis points next year, does that then give me a kicker from renewed bank lending? Does that come from the small business community, which has been the most sort of, I suppose, repressed through this flying high, equity markets? Equity markets look as if they're on fire, but you've had a real recession in small businesses.
Right. I mean, so far we've had what I call the income-driven expansion, where households are earning wages and spending it, but they're not borrowing. Nothing like what we saw in the pre-GFC period or in the 90s when businesses were borrowing a lot to do investment related to the tech sector. And so the reason why that is because rates were elevated enough that it didn't make necessarily sense for them to borrow. But as rates come down, what we're likely to see particularly is a shortening of the duration of borrowing, more floating borrowing, the rise again of the floater mortgage. It's coming back, and as a result, households and businesses are going to be able to use that credit in order to fuel further investment and keep this expansion going.
Okay, well, long live the expansion, long live the records. Bob, good to see you this morning. That's my guest this morning, Bob Elliott of Unlimited. Coming up, President-elect Trump reportedly invited China's Xi Jinping to his inauguration. Will he come? We'll give you the lowdown on that invitation in just a moment, right here on Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It is Bloomberg Brief. I'm Manish Cranny in New York. 3 hours away from the ECB's rate decision. We're expecting our fourth cut of 2024. Lizzie Burton is at the headquarters in Frankfurt. Lizzie, good morning to you. It's been a couple of weeks since there was a frenzy about a 50 basis point rate cut. I think JP Morgan are still tabling that in, but the consensus is 25 basis points for now. How dovish a cut will it be?
Well, you've also got Martin Kazaks, the Latvian central bank governor, saying that it's still on the table. But I agree with you, Manus, it's looking unlikely. You have had those risks emerging since the last meeting. France and German governments collapsing, less fiscal tightening possibly for the ECB to rely on, Trump being elected, and the euro area very much under threat from tariffs from America. So maybe you actually get that feeding into not a jumbo cut today, but a downgrade in the forecast for inflation and growth. Of course, we had Christine Lagarde at the last press conference saying that the inflation risks were tilted to the downside. You had that PMI in November as well. And you could see an update in the statement to the language to be a bit more dovish, as you say, because last time they were talking about keeping rates sufficiently restrictive for as long as necessary. Maybe that gets tweaked this time.
And it's interesting because we've gone through this round of negotiation of wages in Europe, in Germany, I should say. Negotiated wages accelerated to 5.4% in the third quarter. To a certain extent, this is what makes the ECB very, very nervous. We saw a tick up in inflation. Growth wasn't as bad as they expected. And then you have this wage acceleration. But does that fade into 2025?
Well, that's exactly the sort of argument that the hawks would be making against a jumbo cut today. Interestingly, you saw off the back of the US CPI print, because of the changes in Fed bets, actually traders adding to bets for ECB easing by the end of 2025 as well. Look, the bigger question is, if you look at where neutral lies and whether they should go below it and how much further below it, and that comes down to how much monetary policy can do. And as you were discussing earlier, what kind of inflation and growth risks you have in the euro area. We, of course, had this report from Mario Draghi spelling out bluntly that you've got, poor productivity, demographic issues, the lack of financial integration across the euro area. There's not much that cutting interest rates can do about those issues, and that's precisely why the likes of Isabel Schnabel would say you've got to stop cutting rates sooner than perhaps traders would like.
Yeah, well, the divergence is pretty splendid in lots of different areas, from bond yields to currency to economy. Lizzie, thank you very much. We'll track the ECB with you throughout the day. Lizzie Burden at the ECB headquarters in Frankfurt. President-elect Donald Trump has been busy picking his cabinet, according to a report from CBS, though. He's now thinking that who will attend his inauguration. The report is that Trump has invited Chinese President Xi Jinping to the day as he re-enters the White House. Let's get to our White House reporter, Stephanie Lee. Stephanie, here we are. This is one of the best stories that I've read, reaching out to President Xi to come to Inauguration Day. The likelihood of this is fairly thin, isn't it?
It is, as far as we know right now, it does not seem likely that Xi Jinping will attend the inauguration, but it is in keeping with Donald Trump's past remarks and his campaign trail speech to reach out to foreign leaders and to develop a relationship in order to maintain world peace. And that's something that he's been pushing for months and months. So it's not unexpected that he's been taking these meetings with foreign leaders and reaching out to them.
Indeed. Well, another piece of news, of course, that the FBI director, Christopher Wray, has announced he will resign, and this is going to be before inauguration. And to many, this lays the path for Trump's #1 pick to head the FBI, doesn't it?
Certainly. And as far as I know, in terms of my conversations with members on the Hill and with their staffers, it doesn't quite seem like there's been much pushback in the way that we've seen Hegseth and perhaps some of the other nominees get flack or have controversial headlines come up. So as far as we know right now, this does seem to lay the pathway, as you mentioned, for Patel to take the reins of the FBI.
Yeah, well, obviously Christopher Wray saying, look, it's the best way of dragging the Bureau deeper into the fray. So maybe a pragmatic response. That relationship, of course, souring over the past couple of years between Trump and Wray. Also, we've got Bloomberg reporting that Meta made a donation to Trump's inaugural fund. Now, this is a shift for Zuckerberg. We know that he was very praiseworthy of Donald Trump when there was the assassination attempt, called it badass. But this is quite a shift at a corporate level, isn't it?
Certainly. And, what we've been seeing in recent weeks with the relationship of Elon Musk growing closer with Trump, as well as many other CEOs starting to come back into the fold, this seems to be following that trend of business leaders showing their favor or their support behind the president. And so as we're looking at this inauguration, the committee is beginning to solicit funds. And so Meta is just one of the many people who have begun donating to put together this inauguration.
Well, they're all there. I mean, Tim Cook, Sundar Pichai, they're all getting closer and closer to president-elect. And just think, Donald Trump, I think, called Facebook enemy of the people at one stage. That was a bit of a shift, one could say. Stephanie, thank you very much. Stephanie Lee there, our White House reporter on the latest political stories of the day. And now, our exclusive interview with Bloomberg's David Gura. He sat down with the Treasury Secretary, Janet Yellen, as her post nears an end. Let's take a listen.
Well, I am concerned about the fiscal outlook, and I believe the deficit reduction is necessary to keep us on a sustainable fiscal course. Now, President Biden signed into law $1 trillion of deficit reduction over the next 10 years. He did that in the agreement to raise the debt ceiling. And our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't really done anything to, beyond what I've mentioned, to improve the fiscal outlook, and I think that's a shame. I'm disappointed in that, and I think Congress needs to work hard on that. There is a threat going forward that many of the provisions on the individual tax side of the Job Cuts and Tax Act, JCTA, enacted by the Trump administration in Congress in 2017, they will sunset at the end of next year. And many Republicans have expressed a desire to keep all those provisions in place. CBO said that will cost $5 trillion over 10 years. So that really is, and so that would be a blow in a situation where I believe an additional $3 trillion, that not doing the $5 trillion and $3 trillion more is necessary. And if the provisions are just extended, this will be a serious blow without finding ways to pay for them. We proposed a lot of pay-fors that we think would fairly ask corporations, wealthy individuals to pay their fair share. We've negotiated an international tax agreement that would create a level playing field worldwide for multinationals. The United States has not yet joined, although many other countries have. And that would be a revenue-raising measure that I think would be very valuable. And there are certainly more. So I do hope that the new administration in Congress will, if they extend features of JCTA, find ways to pay for what they do, and also make sure that the benefits go not to the wealthiest individuals, but to middle-class families.
Treasury Secretary Janet Yellen there, speaking exclusively with Bloomberg's David Gura. Currency is definitely in focus. We're counting down to the ECB. Will you get your fourth rate cut of 25 basis points is the general consensus. Euro is flat at the moment, 105.02. Dollar Swiss is where the real sort of action was today. The SNB went for a 50 basis point cut, and they've shifted their language. They will adjust monetary policy if necessary. The dollar was up by 0.5%, and the Swiss franc was down nearly 0.6% at one juncture. So we've just bounced back from the highs on the dollar. And the yuan is flat despite the gracious invitation from President-elect Donald Trump to Xi Jinping to come to his inauguration. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I'm afraid that the markets are becoming overextended and that, sometime in the future we will have a downturn in the markets. But I don't think it's going to be a very violent and very far. It will not go very far. So I'm extremely optimistic about the next 4 years and maybe even thereafter.
Into caution coming from the Interactive Brokers Chairman Thomas Petterfy from the Goldman Sachs U.S. Financial Services Conference here in New York. Let me set you up for the rest of your day. The ECB, their rate decision is at 8:15 a.m. Eastern. That will be followed by a press conference by Madame Christine Lagarde. Now, what she says and how dovish a tone she takes is going to be perhaps the more important to the expected 25 basis point cut. We count down to our own data here, US PPI and jobless claims at 8:30. Again, more pieces of the rate cut narrative. We're pretty much a lock for December. But again, it's a question of how hawkish a cut might you get here in the United States of America. On the earnings front, you've got Broadcom, Costco. They come after the market close. Some stocks that we are keeping a track of. You've got Adobe. It's extending post-earnings loss. You have a weaker than expected outlook amid concerns over AI competitiveness. Then you've got Uber. That's rising. Management made some upbeat comments on a conference call on Wednesday. The CFO said that the firm is not seeing any signs of a deceleration in growth in San Francisco, where Google's Waymo is operating. Keep an eye on NVIDIA this morning as well. They're researching autonomous vehicles in China, so that certainly that space is heating up. And Keurig, Dr. Pepper gains as the firm maintains its quarterly dividend. Where are you? Pepsi, Coca-Cola, or Dr. Pepper? Okay, those are some of the stocks that you should keep an eye on. I want to leave you with a snapshot of what's going on under the belly. We've just given a little bit back here this morning. You saw the NASDAQ, the comp flying higher yesterday evening through 20,000. Post-CPI, December is a rate lock. There is one warning signal out there in these markets. The earnings yield on stocks, by the way, that's the closing on the cash, as you can see. Big psychological break level. But here's the thing. The earnings yield on stocks is now 130 basis points below triple B. You haven't had that since the GFC. Surveillance is up next.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
The inflation story is still benign. It's cooling very slowly, but it's still cooling.
We basically now live in a 2% inflation world rather than a 3% inflation world.
You're still running at 3.25%. That's still well above where the FOMC wants to see it.
Consensus is that we are on a downward inflation trend. The Fed does not seem worried about inflation being a little sticky above target.
For the moment, U.S. exceptionalism is a story that's really, really hard to push back on.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Those dark days of stock losses, all 2 of them, ended yesterday with a new record high for the Magnificent Seven. The focus has shifted toward unabashed enthusiasm for central bank rate cuts, and we're getting some big ones. The Bank of Canada and Swiss National Bank both cutting by 0.5 percentage point over the past 24 hours. Now it's on to the ECB, a rate decision later this morning. Futures just losing a little bit of steam in early trading as yields edge upward across the board. In the red, NASDAQ leading on the downside, 0.2%. Not really much to write home about after yesterday's record highs. In the yield space, you are seeing yields climb across the board, particularly on the long end in the U.S. at a time when now the focus goes to if the Fed cuts rates next week, if central banks cut, are we allowing inflation to pick back up? Right now, Jonathan Farrow is off this week. Danny Berger is joining Anne-Marie and myself around the table. Danny, I am curious what you make about some of the front-loaded rate cuts that we're seeing from the likes of the Swiss National Bank and the Bank of Canada.
I'm just wondering how much of this is a willingness to decouple from America, a willingness to decouple at a time where they're facing the threat of tariffs. They already have weak economies, especially in Europe, dealing with political discord. Do they need to get out in front of it and be in a place where they can meaningfully weaken their currency to help some of the growth? And then how much does that come back around to invoke the ire of Donald Trump in 2025?
Well, and this really went to the Swiss National Bank in particular. They actually were pretty explicit in the fact that they want to bring their currency lower, weaker versus some comparative currencies. They even raised the issue of more directly intervening with their currency should this not work. How much is this trying to get all the tools they can ahead of a Trump presidency?
Well, it's also bad news for the Swiss franc because of the politics in Europe itself. It's been a haven. It's had these immense flows because of that. And so they're trying to say, okay, we need to pump the brakes. We need to back off of the strength in the franc before we even have what's coming down the pike from the U.S.
And Anne-Marie, this isn't just a central bank phenomenon, and this is what I find fascinating. It feels as if governments and companies are all reconfiguring, saying we have seen this movie before and we are going to get ahead of whatever might come.
That's right. The writing's on the wall. They have a playbook, and obviously some of them are probably pretty jealous of Elon Musk and his ability to have this relationship, President-elect Trump, and that bet Musk made before the election. So what do you see overnight? Meta donating $1 million to Trump's inaugural committee. Now, while $1 million is really a lot for Meta, right? This is pennies in terms of that company. The fact of the matter is they didn't donate to President Biden's inaugural committee, nor did they donate to Trump 1.0 inaugural committee. So this is tech companies, this is leaders. How many foreign leaders have either called or Trump has sat down with this week alone? Viktor Orban, last week, Emmanuel Macron, Volodymyr Zelensky. They want to make sure that they are in his orbit for that transactional deal making.
What's fascinating to me is how different this is than 2016. There was an outright rejection of Donald Trump and what he brought to the White House back then. This time around, it is completely different. There is a feeling that maybe we have seen this movie before, we can work with it. How does that sort of set the trajectory on a different course?
I think for some executives, it's exciting. We heard recently from Jeff Bezos, who's talking about he's very optimistic about what this could mean. And then recently, in the NBC interview, Donald Trump said, everyone's calling me, and oh yeah, Jeff Bezos, we're set to have dinner.
Meanwhile, we're going to hash through that today at a time where the focus very much is on the ECB coming out at 8:15 a.m. Eastern, as well as PPI and initial jobless claims just 15 minutes after that, followed by the press conference with Christine Lagarde. Coming up this hour, Brian Levitt of Invesco as the NASDAQ 100 notches a fresh record high. Frank Aquila of Sullivan & Cromwell on M&A under a second Trump administration, and Soren Rod of 0.72 ahead of the ECB rate decision. We begin this hour with S&P 500 snapping a two-day losing streak and then now fading just a little bit. Traders boosting bets on a Fed rate cut next week after an inline CPI print. Brian Levitt of Invesco writing, the backdrop for risk assets remains sound given resilient growth and Fed easing. There is little to suggest that this is a business cycle that will be ending. Brian joins us now, and we were just talking about all the reasons why there seems to be at least a renewed bout of outward enthusiasm. Does it worry you that everyone is lining up on the idea that we can get strength without commensurate inflation?
I'm not overly concerned about inflation. I don't think we're going to see a reacceleration in inflation. Instead, what I'm a little bit concerned about is this idea that the U.S. could potentially move to a new, higher, sustained level of growth. I mean, people will focus on tax cuts and deregulation, but not necessarily think about what the uncertainty around trade wars could mean, or what even fiscal consolidation could mean. So it doesn't suggest to me that, again, this isn't a cycle that's ending, but it really comes down to how do you want to think about these markets? Because if you think you're going to a new, higher, sustained level of growth, that's probably a very different investment backdrop than if we're just going to continue in what has been a resilient growth path, but not necessarily one that's reaccelerating to ever new heights.
I saw Steve Asciutto of Mizuho come out yesterday basically saying, sell bonds, buy stocks. And that seems to be what everyone has been saying in an environment, as you said, that is pro-growth. At what point, though, if you have rate cuts around the world that are disproportionate to what we see in the United States, does it make it more attractive? Because traditionally, you chase those rate cuts, and that is your friend, whether it's in bonds or whether it's in stocks.
That's a little bit of the irony of this, because if you remember in 2017, everybody was aligned on a U.S. first story, and non-U.S. markets did very well. So I think people aren't even thinking about the fact that markets outside the United States can perform well, because the expectation is this persistently strong dollar. So the U.S. should do fine. I mean, the median stock in the U.S. is not overly expensive. Yes, the S&P 500 is elevated. The median stock isn't. But other parts of the world outside the United States are priced very modestly, and you just kind of need things to be a little bit better than what they currently are. And you're already seeing some improvements in Chinese economic leading indicators, European economic leading indicators a bit. So maybe that's a surprise to investors next year, is that you start to unlock some of that value.
How low is that bar to say, okay, I can actually buy something outside the U.S.? Because what you're describing, it seems that the bar is kind of low to get some flows into Europe, into China.
The bar is very low. I mean, right, you know, everybody's on this America first. Look, I'm not running away from U.S. stocks, right? But the idea is, do you get a broader market in the coming year, which I think would perhaps surprise people. Broader meaning, beyond just the United States. Bar is very low. And you think about the United States in 2023, people were very worried about elevated inflation. People were very worried about all the tightening that had happened. And there was a lot of people bearish coming into that year. And you and I discussed FOMO, right? We didn't want to miss out on it. And I mean, the reality of it was things just had to get a little bit better. You needed inflation to come down modestly. So maybe that is a surprise to investors. Things are going to get a little bit better outside the United States. And you think about, the dollar being so strong, the market's already priced that the Fed maybe won't cut as much, the tariffs. So a lot of that's already baked into this.
There was an assumption, though, that even just within the U.S., there'd be a broadening. You saw a little bit of that after the election, but this most recent leg higher to new highs has been about the same players, has been about tech, has been about the Mag 7, has been about Tesla. How much of this is a preview of sort of maybe a false dawn of the small cap, mid cap broadening for 2025?
Yeah, that's a bit like if you think back to 2016, 2017, very early on, interest rates jumped. Cyclicals outperformed defensives, right? The whole Trump trade, which didn't persist in 2018 because of the uncertainty around the trade war, because of Fed tightening. Now, this time's a little bit different because you're not going to get the Fed tightening, but you may still have the uncertainty around the trade war. I would expect markets to broaden out largely because the earnings differentials are likely to moderate. Now, that's nothing bad about the Mag 7 over the next 5-10 years. Rather, as everyone's talked about, pretty significant investments that they've made. And so the earnings growth moderates. Small cap, mid cap seem to be closing that gap a bit.
During the first Trump administration, when potentially information was leaked to the press about pulling out of, say, NAFTA and stocks sold off, Trump quickly reversed course because he cared about where the stock market is. Today, he's going to be ringing actually the opening bell at the stock market. Do you think we get that similar tone from the president?
I do, but you have to remember that sometimes these things can get away from you for a bit. And so we haven't had any market volatility in a very long time. It's been a very benign period, and typically market volatility arises when you have policy uncertainty. We saw.
What is that catalyst, though? What would be that uncertainty?
So I keep coming back to the fourth quarter of 2018. I think a lot of people don't remember it. It wasn't an ideal Christmas. The market was down peak to trough 20% by Christmas Eve from 3 months prior, and that was the uncertainty around the trade war. So yes, the administration stepped in, provide better clarity on where that was going. The Federal Reserve backed off. So it was a sign that the administration cared. Right? So my sense is that you may get a pullback in 2025 that people aren't expecting, a policy-driven pullback. That's not the end of the cycle, right? That would be a correction that we haven't had in a while.
But when you say policy-driven, that catalyst you think would be something like tariffs. It would be because of the trade war.
Yeah, as long as, if there's not clarity on it, right? If you say today, this is where we're going and that's where we're stopping, businesses will adjust. The challenge we had in 2018 was it was a full year of trade conflict. And, anytime we went back to our computers, we would see a new tweet about something. And, obviously that's how the incoming president likes to conduct business, keep your trading partners on their heels. But the challenge of it was business investment slowed significantly. It actually stalled. And the market started to look at, if we keep going down a tighter monetary policy path and ongoing uncertainty around the trade war, we may have a recession. And that's what the fourth quarter of 2018 felt like. And of course, again, the administration adjusted path because they do care where the S&P 500 comes. I guess this is the Trump put now, not just the Fed put. So that's the risk. I would advise investors, if that were to happen, that's a buying opportunity. Great, because this doesn't feel, end of cycles don't feel like what we're looking at right now. So
this doesn't sound like you're a raging bear.
No.
But you don't feel like as much of a FOMO kind of guy as he used to be.
Well, we just had back-to-back years of 25, 30% in the market.
Well, hold on a second. To build on that, are you taking advantage of some of these other areas, like outside of the United States?
Yeah, it's worthwhile looking into these other parts. I mean, for one, you're very concentrated in the broad U.S. market. So if you want to equal weight a portfolio or add some size, add some value, add some non-U.S., you still want to be exposed to the U.S. market. But yes, take advantage of other opportunities over the next 1 to 3 year period.
Including China?
Including China.
Brian Levitt of Invesco, thank you so much. And we mentioned China as they come out with more insight into potentially what we're going to get, whether it's issuing debt, whether it's potentially even vouchers for individual consumers. You can see consumer stocks over in China this morning coming out. Anne-Marie, the latest now is also more trying to get ahead of Donald Trump becoming president.
Right, and they're talking about continuing efforts to stabilize the property market, which has been a huge drag on the domestic population. Earlier, before we got these headlines, we also heard from China's Commerce Ministry saying they're willing to strengthen dialogue and coordination with the U.S. to manage differences. They are trying to get ahead of Trump 2.0. One thing we have yet to hear, though, is whether or not Xi Jinping has any plans to make his way to the United States.
And this is going to be key. We'll talk about that more, whether he'll also donate $1 million to the inauguration plans. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. French President Emmanuel Macron is expected to name a new prime minister today. The replacement for Michel Barnier will look to form a new government and restart formal budget talks. Macron faces a deeply divided National Assembly, which ousted Barnier last week by parties on the far left and far right. Parties across the political spectrum have agreed to vote in favor of a special law to avoid a government shutdown. And staying on China, CBS is reporting that President-elect Donald Trump invited Chinese President Xi Jinping to attend his inauguration next month. Xi's attendance, however, would be unprecedented for several reasons. No Chinese leader has ever joined an inauguration ceremony of the U.S. president. In fact, no foreign head of state has attended one in more than a century. That's according to State Department records going back to 1874. And shares of Adobe are falling more than 10% in the pre-market. The software company offering a full-year forecast that fell short of analyst estimates, adding fuel to concerns about the company's ability to compete against emerging AI startups that are making headway in the space. Adobe has been adding Gen AI features to its applications like Photoshop and plans to offer a new, higher-priced AI model to its Firefly. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, gearing up for an uptick in mergers and acquisitions.
I think we're on the verge of a really big uptick in M&A. We've seen a change in administration, which will create a more favorable regulatory review and competition approach.
That was one of the most bullish interviews I have ever heard. We'll be talking about that coming up next. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
market's a little bit softer. The S&P lower by about 0.1%, almost 0.2% after yesterday's record high on the Magnificent Seven. What you can see, yields higher, and this is what I'm focused on. Yesterday, fascinating to see that even after bang-in-line CPI print, after basically an auction that went well, then people started to get nervous about maybe what this meant for long-term inflation. Meanwhile, under surveillance this morning, gearing up for an uptick in M&A.
I think we're on the verge of a really big uptick in M&A. We've seen a change in administration, which will create a more favorable regulatory review and competition approach. So we look at 2025, and we just can't wait for it to get going. My prediction is, other than 2021, which was an aberrational year, this could easily be the best M&A year we've had in say, 10 years.
Here's the latest. President-elect Donald Trump naming Andrew Ferguson as incoming FTC chair to replace Lena Khan. The move raising expectations for mergers and acquisitions under Trump's second administration. The news coming just as grocery store chain Albertsons backed out of a merger agreement with Kroger after it was blocked by a federal judge, as well as following up with a number of vicious back and forths in the legal space. Frank Aquila of Sullivan & Cromwell joins us now, who focuses on mergers and acquisitions. Frank, we heard that incredible bullishness from Paul Taubman. How much is that what you're hearing from pretty much every single one of your clients right now?
Well, I think, first of all, we are definitely hearing it from the investment banking community. And, Paul is somebody I've worked with for a long time, and he certainly knows, what's happening in the markets. What we're hearing from clients is that, deals they talked about 18 months ago, a year ago, they are now talking about, okay, now's the time to do it. Because one of the concerns under the current administration is that even if you got approved, because 98% of the deals go through, is it was taking 6, 9, 12 months for deals that had no anti-competitive aspects to it. So there was a real concern that you'd get tied up in the process and it would sort of freeze you from a strategic financial point of view. So the view is that things are going to happen much more quickly. Yes, certain deals will get blocked, certain deals will get challenged, but it's going to be a distinct minority.
Is there a clear sight of what will get blocked? That there is a certain type of transaction that will come into focus, whether it's foreign money coming into, say, a steel company, or whether it's, say, a tech company looking to pick up another smaller firm?
Well, I think we have to remember that, even in the Ronald Reagan era, which was pretty wide open in terms of merger clearance and antitrust generally, there were deals blocked. So anti-competitive deals have been blocked in every single administration, and I'm sure will get blocked now. Which sectors will they look at more closely? Certainly tech, healthcare to a certain extent, retail, things of that, directly impact the consumer. Those things are definitely going to get looked at very closely.
What do you see the appetite in for foreign companies? And is it driven by this carrot and stick idea of potential tariffs, or is it because they want exposure to U.S. exceptionalism?
I think we were going to see a lot of inbound M&A from Europe and Asia, particularly Japan, even if Harris was elected. The drive is that the U.S. is growing. The markets in both Europe and Asia are fairly stagnant. So that's first of all. The second thing is, if you're selling in the United States, you want to be producing here because the cost and the potential disruption in the supply chain becomes more difficult. So we would have seen it anyway, but it's going to be increased now.
So what would have been your advice for Nippon Steel? Wants to overtake U.S. Steel. Manufacturing factories continue to be in the United States, but both Biden and Trump said that they would block this deal.
I think that's pure politics. Pennsylvania was, the big state in play, and that's really...
So maybe just timing. Don't do it around a huge presidential election with the #1 swing state in focus.
Hopefully that still happens, but we'll see.
I just wonder for companies that are, or private equity, or looking abroad, and companies have international supply chains right now, and they're faced with a potential reality of tariffs changing the entire cost of business. Is that putting deals on ice right now? Are things getting a second look because of the risks in 2025?
You know, I think people have been focused on supply chain issues, not necessarily because of tariffs, but since the pandemic. And that's really when we saw the first disruptions, which a lot of it was what led to inflation. So companies are very much focused on that. But, you know, I think it's a driver of transactions as opposed to an impediment to transactions.
One of the other hopes for a driver of transactions was just a lower rate environment, and we've got that to some extent. But there's a fear right now in this market that the Fed can only go so far. Maybe it's a cut next week and then a pause.
Right.
What does that do to deal activity?
You know, first of all, interest rates are at historically low levels. I mean, we think about the last couple of years when they were extraordinarily low. But, you know, if you look at the Japanese economy where they've had, you know, close to zero interest rates and very stagnant business activity, I think, you know, if the economy is growing and you can build in a 4% interest rate or whatever, you can make most transactions work from a financial point of view. And also, right now, you have a tremendous amount of cash, whether it's private equity groups, strategic buyers, they have cash on their balance sheets, so they don't need to borrow as much. So I think that's a driver as well.
That said, valuations will basically take a hit as a result of rates being higher now than, say, when companies got founded or were bought out by certain private equity companies. And arguably, this is the reason why we haven't seen more exits, why we haven't seen more activity. How much will there be a reckoning in valuations, even if some of these deals get back on the market?
Well, you know, one question is whether or not companies are going to be valued much longer term. So not looking at sort of the next 12 months, but really, you know, 2, 4, 5 years out. And so to the extent that you're doing an acquisition, I think you're going to be prepared to look at it much longer term. In terms of exits, I know talking to you know, people in the VC and private equity world, they've not had a lot of exits the last few years. They're looking forward to a number of exits next year. And I think they're also, whether it's through sales or IPOs, I think the IPO market's going to be hot as well. That's not my area, but I think it's going to be hot.
Paul Taubman said that it's going to be the fastest M&A market in 10 years. Do you agree?
Yes.
Frank Aquila, thank you so much for being with us. Frank Aquila of Sullivan and Cromwell. Really insightful as people keep talking about how much activity there's going to be, whether it's banking or whether it's in the private equity sphere, Danny. It's pretty much what we're hearing across the board.
I find the point about deals happening just faster to be a really fascinating one. Earlier this year, I had a conversation with Orlando Bravo of Tama Bravo, who does a lot of deals in tech. And he said that the process was so gummed up, that they've had to completely change everything they do, that they could get deals done. But to Frank's point, it was taking a really, really long time. So for someone like him, it will be welcome relief.
And potentially, if you were thinking of doing any M&A this year, why would you do that before a presidential election when you know potentially you're going to get the same kind of regulatory overhang of the Biden administration has been very tough on antitrust versus maybe waiting it out and new sheriff in town, as they say.
Are you advising me, Pat Steele? Post facto advisory tip. Maybe not during an election in a swing state. Meanwhile, coming up, Bloomberg's David Gura on his exclusive sit-down with Treasury Secretary Janet Yellen and some of her warnings on tariffs, on trade, going into a different administration. This is Bloomberg Surveillance.
think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Taking back a little bit of what they gave yesterday with the NASDAQ 100 losing the most. Yesterday reaching a record high led by the Magnificent Seven as U.S. exceptionalism once again ascended in big tech. Right now, NASDAQ not so much, down about 1/3%. You can see S&P futures down about 0.2%. More interesting to me was actually what happened in the yield space yesterday. We got CPI came out bang in line with expectations, albeit rising the most going back to earlier this year. At the same time, you saw initially a rally in the bond market, and then, Danny, something changed as the session grew older.
Yeah, which, by the way, you had a strong bond auction, too, so you can't use that to describe what happened. Maybe it is this fear that we know the Fed's going to cut, or at least we assume so, because they say they will. But CPI being not too hot, is that really a good justification to be cutting, especially when the Atlanta GDP tracker is printing 3.3%? There's some nerves in this market, Lisa.
Yeah, especially because, yes, it came in line, and everybody said, wow, that's so good. And then you started to get the roundups. You started to get the exact decimal places that were a little bit higher, and people started to say, hold on a second. You saw the biggest increase year over year in a year and a half. And actually, all of a sudden, people are wondering, okay, if the Fed cuts and you've got the ECB cutting and you've got the S&P cutting and the Bank of Canada cutting, what does this mean longer term for inflation? And suddenly, that long end really saw the sell-off.
And then you look at kind of what are the weaker sectors, the rate-sensitive sectors of the economy, things like housing and manufacturing. Sure, they don't look great, they're wobbly, but they're not getting worse. You could even make the same argument for Europe, which you assume they're going to make bigger cuts. That, look, inflation is still a little bit too high. There is some weakness, but it's more just sort of the politics of it all and the fear of what's coming in 2025. The here and the now maybe doesn't justify 50 basis points of cuts.
Maybe. Either way, right now what you are seeing is very strong focus on the FX market, in part because that is the main transmission mechanism of some of what you're seeing over, particularly in Europe. What you can see is a weaker Swiss franc, and this is by design. This is what's really interesting. You're seeing the euro strengthen just a touch versus the Swiss franc, the euro strengthening just a touch versus the dollar, basically flat. The Swiss franc weakening deliberately after the Swiss National Bank cut rates by 50 basis points, leaving them, Emery, with a 0.5% interest rate, benchmark rate. That is their key rate. And then this morning, a headline dropping that the SNB doesn't like negative rates, but they do work.
But they work. So basically opening the door to the fact that because they have such little dry powder because rates are so low, they are willing to take it negative if need be, especially as they see a more protectionist White House coming into play in 2025.
We'll develop that throughout the morning. Under surveillance this morning, evidence mounting against the alleged suspect in the shooting of health insurance executive Brian Thompson. The NYPD saying Luigi Mangioni's fingerprints and the gun he had on him at the time of his arrest match evidence from the crime scene. Police are also investigating wanted posters of senior executives that have been hung in parts of Manhattan. This, to me, is really the big question mark, Anne-Marie. How much Can police get ahead of any kind of copycat action that might threaten executives of major companies?
This NYPD bulletin that they put out on Tuesday is scary. It says both prior to and after the suspected perpetrator's identification and arrest, some online users across social media platforms reacted positively to the killing, encouraging future targeting of similar executives. Not just can they get ahead of it, but how much are these executives going to their C-suite and saying, actually, we need to upgrade and boost our personal security?
Well, we know they've been having those conversations. Various security heads have said they've been fielding more calls. Shortly after the shooting, there was a gathering of security experts for companies looking at spending more because there is this fear at the moment. And it all just kind of translates to how strange this case is going to be, how strange this trial is going to be. Even before we get him on the stand, the idea of them picking jurors to find people in the public who aren't swept up in all this discontent, who aren't swept up in concerns about the healthcare industry. There's so much evidence against him. But the trial could still be difficult, just given on that very fact.
That trial will be in New York. Over in Washington, D.C., CBS reporting that President-elect Donald Trump invited Chinese President Xi Jinping to attend his inauguration. Xi's attendance would be unprecedented, with no Chinese leader ever joining an inauguration ceremony for a U.S. president. So, Anne-Marie, what gives here?
Well, no foreign head of state has been to inauguration since 1874. What I would say on the inauguration committee, they constantly reach out to foreigners and have some sort of representative. Usually it's the ambassador that shows up to inauguration. I think part of this is just, you know, Trump using his raw power. He's constantly spoke on the campaign trail. He had a great relationship with people like Xi Jinping, and he could be the guy to get the deal done. So maybe he invited him over to say, well, then come to my inauguration. What Xi Jinping is doing and the CCP is preparing, though, for what Trump 2.0 means in terms of higher walls, tougher tariffs.
I'm just trying to understand what the upside of Xi being in D.C. for the inauguration actually would. To see him in the crowd, bundled up on a cold D.C. day.
It's not happening.
But, I mean, imagine the optics of well, thank you, Anne-Marie, but the optics of Trump saying something and he literally can't respond and he's sitting there in the front row. There's little upside to that.
This reminds me of when you have two girls and one of them has been trash talking the other one, and the other one invites them to a party where they're going to show up and no one's going to like them, and they know they're not going to come. It's just a massive power movement, but I'm going to put that aside. Meanwhile, NVIDIA ramping up hiring in China. Sources telling Bloomberg the chipmaker will end the year with about 4,000 employees in the country, up from about 3,000 at the start of 2024. That included 200 people added to a team in Beijing working on new autonomous driving technology. Fascinating, Danny, that at a time when we're talking about China cracking down on U.S. companies, you have a major U.S. company, the largest company, expanding in the region.
China specifically cracking down on NVIDIA, too. Earlier this week saying that they were probing a takeover they were doing, probing it on antitrust efforts. You feel Jensen Huang in the middle of these two world superpowers, trying to navigate them both. Shortly after Trump was elected, Huang said that he would agree with any sort of restrictions he put on place. He would comply with it. And he was also just in Hong Kong giving an address saying that China is a great place for AI innovation, even though they can't sell their most advanced chips into China. So I think in one way, you could very much so view this as a diplomatic overture, saying we're going to be hiring in China, we're committed to this market, even though we can't sell everything we want to into it.
At the same time, you have incoming officials like who is going to be Secretary of State Marco Rubio, Jamieson Greer, who's going to be the ambassador at USTR, basically saying we need to decouple. There's no silver bullet when it comes to China and their dumping of excess capacity on foreign markets, and also how they treat U.S. companies, saying we should decouple. So how much harder is it going to be for any company to start ramping up this hiring like we've seen at NVIDIA?
Talking about future Secretary of States, current Secretary of State, Treasury Secretary, or not Treasury Secretary, Secretary of State, Treasury Secretary Janet Yellen urging the U.S. to maintain open channels with China. In an interview with Bloomberg's David Gura, Yellen also expressing concerns about wider tariffs. Take a listen.
Broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. A broad-based approach, I have serious concerns with.
Bloomberg's David Gura joins us now. David, what was the main takeaway for you, given the fact that Janet Yellen knows that her time as Treasury Secretary is limited, and she's handing over the reins to administration with a very different view than what she's had?
I went into this interview wondering how she was going to be. Was she going to be wistful? Was she going to be worried? Was she going to be ready for the exits here fewer than 40 days? I think that she retained some optimism that in the time that she has left, she's going to be able to convey, yes, to the American people, all that this administration has done in terms of economic policy, but also convey to this incoming administration what's important, what she's learned while she's been on this job. So taking China as an example, she has perhaps the best conduit of communication between Washington and Beijing. She believes that rebuilding that was crucial, that it's important to maintain the integrity of that. I think she wants to convey to Scott Bessent and his team that there should be an effort to preserve that, even if the rhetoric from on top from President-elect Trump is going to be in favor of these kind of universal punitive tariffs. You misspoke and called her Secretary of State. You can be forgiven for that because she's had such a huge diplomatic role in the job. I mean, she is somebody who's really embraced the kind of international profile of this job, and I think that that's something that she's also trying to convey, maybe indirectly to Scott Bessent, is that there's more to this job than just focusing on tax policy and some facets of domestic policy. You really are kind of a huge paramount policymaker for the country and a huge person on the world stage. And I think she wants to kind of emphasize that in these final days.
The two did have a call, and I'm wondering how much of that centered on this idea of tariffs. It's interesting to hear her say that there shouldn't be blanket tariffs because she lost that argument within the Biden administration. It was Treasury that wanted to maybe lift some of the Trump tariffs, and they kept them on. She have any insight into potentially how that could have been handled differently?
We didn't talk about the history, but it's a very good point. And, I think that what was interesting is how she still, somebody who was trained and worked as an academic economist, really relies on the literature and what we know of the effects of these tariffs. And it's kind of almost funny to hear that in this moment when the rhetoric seems to have shifted so much to the way that the Trump administration, future Trump administration thinks things could be, or how these tariffs might work out, or the effects that they might have. She is still somebody who I think recognizes the kind of usefulness of tailored or finely tailored tariffs, not broader-based ones, but a very good point about how they, she lost that fight.
So they have like 6 weeks left.
Yes.
Jenny Leonard and I were reporting that potentially they're going to go a lot harsher on Russia right before they leave the administration. Do you get a sense that they're ready, her and her OFAC team are ready to cripple Russian oil revenue even more with sanctions?
Very grateful that you had that story because I could ask her about it when I came in. Can you confirm that these discussions were taking place? And she didn't want to get ahead of sanctions, she said, but she did talk about the opportunity when it comes to oil at this moment in time, given the price of oil. And I think probably a dissatisfaction and frustration with the fact that the Russian economy has proven to be, I think, more resilient than she would have hoped or expected it to be. And that's not to say it's what it was before this incursion began, but certainly this is a thing that they could target, be that crude exports, be that the shadow fleet of tankers. And she did allow, and not directly, that it's something that they're exploring and they see the opportunity for it in large part because of just the economic situation that they're in right now.
I was also so fascinated what she said to you about fiscal sustainability, because there is some irony in it, given that fiscal deficits ballooned under the Biden administration and under Janet Yellen. What did you take of her, I guess we can call it, apology of their lack of more work?
So here there was that wistfulness, I think. And, she's somebody who, over her long career in Washington, has been identified as a fiscal hawk, and that really has not been a facet of her tenure in the Treasury Department. It began with all of this spending because of the pandemic. She brought this up at a Wall Street Journal event earlier this week. We talked about it ourselves, and she leaned on the fact that in the budget that the president proposed, there were efforts made to kind of reduce the deficit. Of course, none of that's come to pass. Not even the budget has come to pass because we don't have regular order in the way that we used to before. But I think that it is something that she does have regrets about. She said that explicitly, and I think that she recognizes there's a failure of progress there. And also, I asked her directly, are you worried about kind of the state of fiscal matters here in this country going forward? And it is something she said that is of concern to her. And I think that there's a recognition of the fact that it doesn't seem like that's likely to change markedly here in the next
Did you get a sense of how she feels about her legacy? Maybe looking forward to not being in that position anymore, but we're about to get a very different Treasury Secretary and a very different Washington, D.C.
She talked a lot about the institutions that she's been a part of, and she really has had this extraordinary career where she's been in the White House, she's been at the Federal Reserve, she's been at the Treasury Department, and had leadership roles in all three of those places. So I think she's reflecting on that, the opportunity she's had and the work that she's done, but things are likely to change. And I think the backdrop to all of this is that the policies that she's kind of pioneered and been party to, so supply side economics, multilateralism, these are all things that she's really worked hard on, tried to evangelize for. And you're right, we're at a point where all of that's changing. And again, while she wasn't evincing any sort of sadness in that interview, I think it's a real moment where things are starting to change, and she's kind of recognizing that as she goes back to perhaps California, where she spent a lot of time, and I think she's going to divide her time between D.C. and California.
Sounds pretty rough. David Gura, thank you so much. Wonderful interview. Really excited to really just deep in and dig. And you actually have another interview coming up, which we will get to in a minute. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. China is vowing even more fiscal support. Top officials led by President Xi Jinping are promising rate cuts, a higher budget deficit, and efforts to boost the property market. Comments come from the Central Economic Work Conference in Beijing. China is facing uncertainty heading into 2025 with the threat of new tariffs and a possible trade war under the incoming Trump administration. Meanwhile, the International Energy Agency expects a global oil glut next year, despite OPEC Plus delaying its supply increases. The agency is saying that if the group continues with its plans to revive output in April, world markets will still face an oversupply of 1.4 million barrels a day. And they say that if OPEC Plus were to cancel hikes for all of next year, there would still be a glut of 950,000 barrels a day. And Microsoft will take an $800 million charge after General Motors shuts down its autonomous cruise operation. The tech giant had announced a minority investment in the initiative back in 2021. Microsoft said in a regulatory filing that the charge will have a negative impact of about 9 cents a share. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the U.S. versus the rest of the world.
People are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that trend. It's hard to convince someone to sell the U.S. and buy European equities right now.
That's next. Maybe someone who actually has a different take. This is Bloomberg Surveillance.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Futures pulling back just a touch after yesterday's all-time high on the NASDAQ 100, led by the Magnificent Seven, a 0.2% decline in the S&P. Yields higher, and I'm watching this space at a time when you actually had an okay auction yesterday. 10-year yields in the U.S., 4.2964, rounded up to 4.3%, at a time where yields in Europe falling lower. Under surveillance this morning, the U.S. versus the rest of the world.
People are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that. The positioning and sentiment setup is a little bit offsides, to Lisa's point, on U.S. being sort of exceptional versus rest of the world. It's hard to convince someone to sell the U.S. and buy European equities right now. Both for Europe and China, you can have episodic periods of outperformance, especially given the positioning dynamic. The question is follow through.
Here's the latest. Under 2 hours away from the final ECB rate decision of the year, the central bank widely expected to cut rates for the fourth time this year as it looks to boost the region's struggling economy. Zoran Rada of European Economic Research writes, the governing council is likely to put a more emphasis on downside growth risks, with inflation at target earlier than previously anticipated and growth risks skewed more strongly to the downside. We expect dovish rate guidance changes. Zoran Rada of 0.72 joining us now. Zoran, I'd love your take right now on just how low the bar is for the European economy to outperform.
Good morning, Lisa, and thanks for having me on the program. I think the European economy is going to have a difficult year next year. There are a lot of headwinds. Some of them, of course, have to do with the international environment, with the prospect of a potential trade war. Some of them are very much homemade, like political uncertainty in France. And in an environment where I think fiscal policy in Europe at least has very little by way of being ability and capacity to lean against that, it's really hard to see for Europe to outperform those low expectations next year. The ECB is really the only game in town at the moment.
And this is the reason why people are calling for maybe even a 50 basis point rate cut. Pretty broadly, everyone's expecting 25 basis points. They're not going to follow in the footsteps of what we saw from the Swiss National Bank. But maybe this is just a concession to some of the more hawkish members to create a more dovish tone as to future guidance. Is that your take as well?
I would say so. I mean, ECB decisions and communication, they're usually a package, and they're usually some sort of a compromise that makes most people happy. ECB President Lagarde is also a leader who, strives to have a broad consensus in the governing council. And that then often means that they, take not radical decisions, but essentially come up with a package. So today, I think that will mean 25 basis point cut paired with guidance changes. And those guidance changes, I think that's really the bone of contention of this meeting.
Soren, I'm interested by this idea that you say the ECB is the only game in town, because there have been other, so to speak, games presented. That is the Draghi report for steps that Europe can take to promote growth, with little expectations of that happening. Is an ECB that continues to cut rates, that forces the euro weaker, is that enough to get the European economy off the ground?
We don't think it's enough to get the economy off the ground in the near term. That's why our forecast for growth next year is just 0.8%. That's below consensus and about 1/3 of where we see US growth. We think it will take time. I think there are some factors looking into 2026 that can make us more constructive. Hopefully some form of trade deal with the US is one of them. The lagged effects of ECB easing is another one. And we do expect the ECB to actually cut rates further than they now think they will, so into accommodative territory. Another one is a potential truce of whatever form in the Ukraine, with subsequent reconstruction efforts. So there are reasons, I think, to be more constructive about 2026, but I think all those factors will take time to shape out, and so 2025 is, I think, going to be a tough lift.
There still is this irony of an ECB, if they continue to cut, because inflation still isn't at target, Soren, and it presents this argument of moral hazard, that politicians in Europe are acting recklessly because they know they have an ECB that has their back. Do you put any credence to that?
I mean, I would say, first of all, to inflation, we're now expecting inflation in our own focus at 2.2%. The ECB is probably going to be a bit below that next year, and then essentially staying at target with risk to inflation coming lower, right? So yes, core inflation is still running well above target, but a central bank that is faced with such a weak growth outlook, I think, should be more forward-looking. I think we've heard from several speakers, including Christine Lagarde, that that's the direction of travel. They want to and expect to become more forward-looking. They're just not there yet. I think in practice they are there. So inflation is not really the main concern. As to your question on moral hazard, I think in general, financial markets are a pretty powerful disciplining device. And, yes, we've had a lot of political turmoil in France. And in the end, we expect the deficit in 2025 to be not much smaller than the one we're likely to get this year. In other words, with a 6 handle. But on the other hand, we've seen that financial markets are pretty reactive to political uncertainty and will